All right, so we've got this uh, pretty hefty stack of articles and notes here, all about investing.
Yeah.
Looks like you're interested in kind of like mixing and matching
Yeah.
two major approaches. So we've got Benjamin Graham's value investing, and then we've got dollar cost averaging.
Yeah, it's interesting because those seem like two separate universes, right?
Yeah.
Like when you think about it,
Right.
one is all about picking the right assets and the other one is like, well, when do you buy them?
Right.
But there is this like fascinating potential synergy between them.
Totally. And I think we can get into that for sure.
Yeah.
Yeah, so we've got excerpts here from a bunch of different articles. So all notes, 090202025.
Yeah.
Benjamin Graham's timeless investment principles. We got dollar cost averaging, DCA explained, with examples and considerations,
Yes.
and even some insights from the Moo community.
Very cool.
So you've been doing your research.
Yeah, definitely.
Okay, so really our mission today in this deep dive is to help you unpack these ideas and see how they could potentially work for you.
Yeah, make it practical.
Yeah, exactly.
Yeah.
Make it real.
Absolutely.
So to start, I think we have to set the stage with Benjamin Graham, who's often considered the father of value investing.
Yeah, the OG.
Right.
Yeah.
What makes his approach so special?
Well, one of the core ideas, and one of the ones he's most famous for, is this idea of the margin of safety.
Yeah, I've heard of that.
Yeah.
You're not just looking for a good deal, you're looking for like a screaming deal.
Yeah, exactly.
Yeah.
And Graham believed that by buying with a large margin of safety, you're minimizing your risk.
Okay.
And you're setting yourself up for potentially huge returns.
Makes sense.
And he even had this really brilliant analogy to explain how to find these opportunities, and it's called Mr. Market.
I've heard of this Mr. Market. Tell me more.
Okay, so imagine Mr. Market is this emotional fellow, okay?
Okay.
And he shows up at your door every day offering to buy or sell you stocks.
Oh my gosh.
So some days he's super excited, like he's overly optimistic and he overprices everything.
Right.
Other days he's like gloomy
Yeah.
and pessimistic and he offers you ridiculously low prices.
Yeah.
The key, according to Graham, is to not let Mr. Market's moods influence your decisions.
So you're saying don't get caught up in the hype or the, panic.
The fear, exactly.
Yeah.
Don't get swept up in that. Stay focused on what the asset is actually worth.
Okay.
Not the price tag Mr. Market is trying to slap on it that day.
So essentially like separate the emotion from the decision.
Exactly.
Yeah.
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 And this kind of leads into another key distinction that Graham made between an investor and a speculator.
Okay, so I'm guessing in this scenario, I don't want to be the speculator.
Probably not. The speculator is chasing quick profits, often ignoring the underlying value of the business.
Right.
So they're just trying to time the market, make a quick buck, and get out.
Got it.
The investor, on the other hand, is in it for the long haul, carefully analyzing the fundamentals and looking for those opportunities that Mr. Market has mispriced.
Okay, so essentially, the investor's looking for a long-term sustainable strategy.
Yeah, absolutely.
So how do you actually go about finding those hidden gems that Mr. Market is practically giving away?
Right. It's not just about going bargain hunting, right?
Right. Yeah, exactly.
Like, how do you know?
What are the signs?
Yeah, what to actually look for.
Yeah.
Well, Graham provided a really useful framework for identifying potentially undervalued companies.
Okay.
And one of the key metrics that he focused on was the price to earnings ratio, or the PE ratio.
I've heard of that one, yeah.
Yeah.
So that's basically just the price of the stock divided by the company's earnings per share.
You got it.
Okay.
And Graham believed that a lower PE ratio could indicate that a company is undervalued.
Compared to its earnings.
Exactly.
Okay.
So essentially you're paying less for each dollar of profit.
Right.
But he didn't just stop there. He also looked at other financial ratios.
Like the price to book value, debt to equity ratio, all sorts of things to really assess a company's health.
So it sounds like he was really all about like doing your homework.
Absolutely, yeah.
Looking under the hood.
Due diligence.
And understanding the true value of the business before making any moves.
Yeah, and one of your sources here, all notes 090200025, even mentions that he had these specific criteria for what he called defensive stocks.
Okay.
So these are companies that are particularly resilient.
Yeah.
And he based these criteria on things like their annual sales, their current ratio, and a track record of positive earnings.
So essentially like looking for businesses that could weather a storm.
Exactly.
Yeah.
Yeah. You wanted to make sure that the companies he invested in could withstand tough times.
So he was clearly very risk averse, it sounds like.
Yeah, definitely minimizing risk was a huge part of his philosophy.
Okay, so we've talked about minimizing risk, but then also maximizing returns.
Right.
So far it seems like Graham was focused on the minimizing risk side.
How does dollar cost averaging fit into all of this?
That's a great question. That's where things get really interesting.
Yeah.
So DCA is all about consistency
Okay.
and discipline instead of trying to perfectly time the market.
Yeah.
Which, let's be real, is nearly impossible.
Yeah, pretty much.
DCA involves investing a fixed amount of money
Yeah.
in a specific asset at regular intervals,
Okay.
no matter what the price is doing.
So it's kind of like setting it and forgetting it a little bit.
In a way, yeah. It's like having an automatic investment plan,
Yeah.
like every month buy X amount of this stock.
So you're not tempted to wait for a dip or anything like that.
Exactly. And one of your sources, dollar cost averaging,
Mhm.
DCA, explained, with examples and considerations,
Yeah.
highlighted a really interesting study that showed just how powerful this can be.
Okay.
So it showed that during the 2008 financial crisis, using DCA for the S&P 500 would have actually resulted in a positive return,
Right.
while lump sum investing at the beginning of that period would have led to a significant loss.
So even during a major crash, DCA could still work.
That's the amazing thing about it.
That's incredible.
Yeah, by investing consistently over time, you're basically averaging out your purchase price.
Right.
So when the market dips, you're buying more shares at a lower price.
Okay.
And when the market rebounds, those shares you bought at a discount become more valuable.
So instead of being afraid of the dips, you're taking advantage of them.
Exactly. You're using volatility to your advantage.
So where does the synergy come in between DCA
Yeah,
and Graham's principles?
right. So imagine you've done your research.
Yeah.
You found this company that meets all of Graham's criteria.
Okay.
Strong financials, good management potential for growth.
Yeah.
But the market is just being unpredictable.
Right.
Instead of trying to wait for that perfect entry point.
Yeah, because who knows when that's going to be.
Exactly.
Right.
DCA lets you gradually build your position over time, taking advantage of any dips along the way.
So you're not just buying a great company, you're potentially getting it at a great price.
Exactly. You're maximizing your return potential while still minimizing your risk.
That's pretty awesome.
Yeah, it's a really powerful combination.
So you're also essentially taking the emotion out of the equation.
Exactly.
Because you're not constantly checking the stock price and freaking out or getting greedy.
Exactly. You're trusting the process and staying disciplined.
Okay. This is really starting to sound like a winning formula.
Right.
Are there any downsides to DCA?
Of course, no investment strategy is perfect.
Fair enough.
And one of your sources, dollar cost averaging, DCA, explained, with examples and considerations, points out that in a consistently rising market,
Okay.
DCA might actually underperform
Oh,
compared to investing a lump sum up front.
interesting.
Yeah, because you're spreading out your purchases.
Yeah.
You might miss out on some potential gains.
Okay.
So it's a trade-off, right?
Yeah.
Potentially sacrificing some upside to mitigate the risk of buying at a peak.
So DCA really is best for a volatile market.
Yeah, it shines when the market is uncertain.
Okay.
But in a bull market where everything's going up,
Yeah.
you might be better off just putting all your money in at once.
Got it.
Yeah.
So it's all about finding the right approach
Exactly.
for your own, risk tolerance and goals.
Yeah, absolutely.
Awesome. Okay, so we've covered some of the basics of Graham's investing principles and kind of dipped our toes into how DCA
Yeah.
can be a helpful tool. But how do we actually put all this together in practice?
That's a great question, and that's where we'll pick up
Okay.
in part 2 of this deep dive.
Awesome. I can't wait.
Yeah, it's going to get really interesting.
Let's do it.
All right.
Welcome back. All right. So I'm excited to get into some real world examples
Yeah.
of how these concepts actually work.
Yeah, I think that's important, right? Because the theory is great,
Yeah.
but seeing it in action
Right.
really brings it to life.
Totally. Okay, so one of the articles you sent, how 16 Benjamin Graham-inspired rules return 38% annually, had this super interesting case study about a company called Albemarle and Bond Holdings.
Oh, yeah.
So this was a British company that operated pawn shops.
Okay, interesting.
And it caught the author's eye because it had this crazy low price to NCAV ratio.
Ah, yes, that's a classic Graham metric.
Okay, so for those of us who don't know, can you break that down?
Yeah, NCAV stands for net current asset value.
Okay.
And essentially, it's a way to figure out what a company's liquid assets are minus all of its liabilities.
Okay, so it's kind of like what would be left over if they sold everything and paid all their debts.
Exactly.
Yeah.
And a low price to NCAV ratio suggests that you're essentially buying those assets at a bargain.
So this is like a prime example of Mr. Market having a bad day.
Maybe he was in a really bad mood that day.
Yeah, totally.
But here's where it gets interesting.
Okay.
So the author didn't just jump in based on that one ratio.
Okay.
He actually dug deeper, and he used this scorecard
Okay.
that he created called the Net Hunter Core 7.
Ooh, that sounds like a secret weapon.
Yeah, it's like a checklist
Okay.
that's inspired by Graham's principles.
Okay, so what's on the checklist?
So it goes beyond just the numbers,
Okay.
and it looks at qualitative factors,
That
such
might be
as
the-
a Tonley insider ownership.
Okay.
So are the company's own managers actually buying the stock themselves?
Oh, interesting. Okay.
Yeah, and catalysts.
Okay.
So events that could potentially unlock value.
So you're kind of looking for, are there any like, upcoming things that could like change the game for this company?
Exactly, yeah.
Okay, so he's looking at this company that's got the low price to NCAV ratio, and then he's also looking at this checklist.
Yeah, and in the case of Albemarle and Bond,
Yeah.
some red flags started to pop up.
Okay.
So, for example, their debt-to-equity ratio was quite high,
Yeah.
meaning they had a lot of debt
Yeah.
compared to their assets.
Which goes against Graham's emphasis on financial stability.
Exactly. Yeah, he always stressed the importance of a strong balance sheet.
So even though the price seemed really good, there were these kind of like underlying issues.
Right. It was like a shiny object, but when you looked closer,
Yeah.
it wasn't as attractive.
Right. Okay.
And here's another interesting detail.
So-
So the company was actually actively looking for a buyer,
Oh, okay.
but they couldn't find one, which suggests that other investors weren't seeing the same value.
Even though the price was low.
Exactly. Even though it seemed like a steal,
Yeah.
other investors were saying no thanks.
Okay, so that's like a big red flag.
Huge red flag.
Yeah.
Yeah. So
Yeah.
did the author end up investing?
I'm on the edge of my seat.
Well, he decided to pass.
Oh, wow.
And
Yeah.
just 2 months later,
What happened?
Albemarle and Bond Holdings filed for bankruptcy protection.
Oh, my gosh.
Yeah.
So it really was like a ticking time bomb.
It just goes to show that even seemingly undervalued companies can completely implode.
So those numbers can be deceiving.
Absolutely. Yeah. And that's why that margin of safety that Graham emphasized
Yeah.
is so important.
Right.
It helps you protect yourself from those hidden risks.
Yeah, so this Net Hunter Core 7 is a great tool, but it's not foolproof.
No tool is foolproof.
Yeah.
You still need to use your judgment.
So where does DCA fit into all of this?
Yeah.
Could it have saved the day in this situation?
That's a great question.
Yeah.
I mean, in this specific case, DCA probably wouldn't have prevented a total loss
Okay.
because the company went bankrupt,
Right.
but it could have potentially mitigated the losses.
Oh, yeah, so.
Well, let's say an investor was really intrigued by that low price to NCAV ratio,
Yeah.
but they were also a little bit hesitant because of those red flags.
Right. They've got that checklist.
Exactly.
And they're like, I don't know.
Instead of going all in, they could have used DCA to gradually build their position over time.
So if the company continued to struggle, they wouldn't have lost as much.
Exactly.
Okay.
DCA provides that buffer, averaging down your purchase price and potentially reducing your overall risk.
So even though DCA can't like completely, save you from a bad investment,
Right.
it can soften the blow.
Exactly. Okay.
Yeah. It's about managing risk, not eliminating it.
Okay. So we've talked about DCA as this kind of like consistent
Yeah.
approach to investing.
Yeah.
But one of the articles, How to Build a Complete Benjamin Graham Portfolio, talks about how Graham actually recommended different strategies
Oh, interesting.
based on an investor's grade.
Go.
So essentially their level of,
Experience.
expertise,
Yeah.
all that. Yeah.
He recognized that not everyone has the same amount of time or resources or even risk tolerance.
So like a personalized approach.
Exactly.
Okay, I like that.
Yeah.
So tell me about these grades.
All right. So he had recommendations for what he called zero effort investors,
Okay.
minimum effort investors,
Sorry.
and enterprising investors.
I got it. So each with a different set of strategies.
So zero effort.
Yeah.
Like, what does that even mean?
So for those who are really looking for a hands-off approach,
Right.
Graham recommended investing in things like blue chip stocks
Yeah.
or index funds.
So you're basically just investing in the overall market.
Exactly. Yeah.
And you're not trying to like pick individual winners.
You're letting the market do the work for you.
Yeah.
Then for those willing to put in a little bit more effort,
Okay.
he suggested focusing on what he called defensive grade stocks.
Okay.
So these are companies that meet specific criteria related to financial stability,
Okay.
consistent earnings, and dividend payments.
So you're still going for safety and reliability,
Exactly, yeah.
but you're being a little bit more
Yeah.
selective.
You're doing a little bit more research.
Okay.
And then for the enterprising investor,
Okay.
Graham opened up the world of enterprising grade stocks.
So this is where it gets exciting.
This is where the fun begins.
Oh, yeah.
So these are companies that might be undervalued.
Yeah.
Due to temporary challenges or market misperceptions.
So you're really like digging deep.
You're hunting for those hidden gems that Mr. Market has overlooked.
Yeah.
Yeah.
Okay.
But it requires more research, more analysis,
Yeah.
and a higher risk tolerance.
But also potential for bigger reward.
Exactly.
Yeah.
High risk, high reward.
Okay. So essentially Graham was saying you can choose your own adventure.
Exactly.
Like when it comes to investing.
He created this really personalized framework
Yeah.
that recognizes that there's no one-size-fits-all approach.
So where does DCA fit into these different investor grades?
Yeah, that's a great question.
Can it be used across all levels?
Absolutely.
Okay, good.
And that's what's so great about it.
Yeah.
So for those passive investors who are maybe focused on index funds or blue chips,
Yeah.
DCA can be a really simple and effective way
Yeah.
to steadily build their position over time.
So you're not stressing about like when to buy or when to sell.
Exactly. You're just consistently investing.
And letting the market do its thing.
So for those defensive grade investors, can DCA help with that strategy as well?
Yeah, for sure.
That's
So
right.
for those who are investing in those more stable companies,
Yeah.
DCA can actually help smooth out any short-term volatility.
So it's like you're adding like another layer of safety.
Yeah, exactly. You're making an already conservative approach even more stable.
Okay.
And then even for those enterprising investors, DCA can still be a really valuable tool.
Okay.
Especially for those special situations that we talked about earlier.
Wait, so I thought special situations,
Yeah.
like those require quick action and like
I do.
a deep understanding of like what's going on.
Yeah.
So how does DCA play into that?
Well, sometimes those events can take time to unfold.
Okay.
So let's say you've identified a company that's undervalued because it's going through a restructuring.
Okay.
That process might take months or even years
Oh, wow.
to fully play out and for the market to kind of like recognize the true value.
So instead of trying to time it perfectly, you're just kind of like steadily buying in.
Exactly.
Okay.
You're averaging out your entry point over time
Got it.
and reducing the risk of, buying at the wrong moment.
That's super helpful.
Yeah.
Okay, this is really eye-opening.
Yeah.
I'm starting to see like how DCA can really be this like super versatile tool.
It is.
It's like a Swiss Army knife of investing.
It can really complement any value investing approach.
Okay, so before we wrap up this part,
Yeah.
I'm curious about that article about building a complete Benjamin Graham portfolio. You mentioned there was a fourth strategy
Oh, yeah.
that even Graham considered
Right.
pretty advanced.
Yeah.
So tell me more.
So this is the realm of what we call special situations.
Okay.
And these are opportunities that go beyond
Okay.
traditional value investing.
Okay, so what kind of things are we talking about here?
So we're talking about things like mergers and acquisitions.
Spin-off bankruptcies.
That sounds intense.
It can be, yeah.
Is this something that like the average investor should even be thinking about?
It's definitely not for beginners.
Okay.
Special situations require a deep understanding of both the market
Yeah.
and the specific companies that you're looking at.
Okay.
You have to be comfortable with a higher level of risk
Yeah.
and complexity.
So it's like the extreme sport
Yeah.
of value investing.
You could say that,
Okay.
but for those with the expertise and the stomach for it,
Yeah.
special situations can offer incredible returns.
Okay.
Often returns that are independent of what the broader market is doing.
So it's like you're finding these little pockets of value.
Exactly. You're almost like an arbitrager. You're
Yeah.
finding these discrepancies in the market
Yeah.
and you're capitalizing on them.
Okay.
But it's important to remember that this strategy comes with its own risks.
Of course.
Yeah. You might need to analyze legal documents,
Oh my God.
decipher complex financial statements.
You might even need to consult with industry experts.
This is a whole other level.
It's a different game.
Yeah.
So yeah, it's fascinating. It's potentially lucrative, but it's not a casual endeavor.
So it's really for those who are like super serious about investing.
Yeah, it's like a full-time job.
Oh.
for people who are really dedicated to mastering this area.
Oh, this is amazing.
And even Graham himself
Yeah.
cautioned that this approach is really best suited
Oh.
for experienced investors
I'd
with
be-
specialized knowledge.
Okay.
It's not something to jump into lightly.
Wow, this deep dive has really blown my mind.
It's fascinating, isn't it?
The world of value investing is so much bigger
Yeah.
than I ever realized.
It's amazing. And you know what's really cool is that
Yeah.
while we've been focusing on your specific interests and
Yeah.
the sources that you provided,
Yeah.
we've also touched upon some concepts and strategies that are relevant to literally anyone who's interested in investing.
That's awesome.
So whether you're a beginner or an expert,
Yeah.
the principles of value and discipline and risk management, those remain constant.
Those are the foundational building blocks.
Exactly.
Okay, so it's like we've uncovered these timeless truths
Yeah.
that can guide anyone
Yeah.
on the investing journey.
It's a journey, not a destination.
Okay.
And it's exciting.
This has been an amazing journey so far.
Yeah.
But I have a feeling we're not done yet.
You're right. We've got one more part to go.
All right. So stay tuned, everyone, for the grand finale.
We'll see you there.
All right, welcome back to the final part of our deep dive into value investing and dollar cost averaging.
It's amazing how much we've covered.
I know, right?
It's like drinking from a fire hose of information.
It really is.
But it's good stuff.
It's good stuff. So we started with the foundations of Benjamin Graham's approach. Then we went into all the nuances of DCA.
Yeah.
And even touched on the really exciting world of special situations.
Right. And what's really cool to me is
How all these pieces fit together.
it's like we've been building a puzzle.
It is kind of like a puzzle.
Yeah.
And you start with this cornerstone of value investing.
Yeah.
And then you're adding all these layers of strategy
Yeah.
and insight on top of it.
I like that metaphor.
And the cool thing is that this puzzle
Yeah.
isn't one size fits all.
Right.
So you can tailor it to your own goals, your risk tolerance, and really the amount of time and effort that you want to put in.
Exactly. And, speaking of time and effort, one thing that keeps coming up for me is this idea of balance.
Oh, yeah.
Balancing discipline with flexibility.
Definitely.
So GCA provides that consistency, right? Almost like an automated approach.
Yeah, it's like setting it and forgetting it in a way.
What? We also saw how important it is to stay informed.
Absolutely.
And be ready to adapt.
Yeah, you can't just blindly follow any strategy.
Right.
You have to be aware of what's happening.
Right. And be ready to make adjustments.
Yeah, and I think back to that case study with Albemarle and bond holdings.
Yeah.
Even though the numbers looked good initially.
Right. They had that tempting price to NCAV ratio.
Yeah, exactly.
But when you dug deeper, there were all those red flags.
Yeah, and DCA might have helped to soften the blow a little bit.
Yeah. It could have reduced the losses.
But it wouldn't have saved the day.
Right. It's not a magic bullet.
Exactly.
Yeah.
So DCA is great.
Yeah.
But it's not a substitute for really understanding what you're investing in.
You still have to do your homework.
Yeah, and being willing to make changes if you need to.
Exactly. It's like having a GPS.
Okay.
It can guide you,
Yeah.
but you still need to pay attention to the road.
Right, and be ready to take a detour.
Exactly.
If there's construction or something.
Exactly.
Okay, I like that.
Yeah.
So it's not just about setting up that automatic investment plan.
Right.
And then totally forgetting about it.
No, you have to stay engaged.
Yeah.
You have to review your portfolio, reassess those fundamentals, and be prepared to change course.
Which kind of brings us back to one of the main themes, I think,
Yeah.
of this whole deep dive.
Okay.
The idea that successful investing is a journey.
Absolutely.
It's not a destination.
It's not like you just arrive
Right.
at financial success one day and you're done.
Yeah.
It's a constant process.
Exactly. It's about constantly learning,
Yeah.
adapting, refining your approach as you go.
Yeah, like leveling up your investing skills.
Oh, I like that.
Yeah.
And as you level up,
Yeah.
you might find yourself venturing into those more complex strategies.
Right.
Like those special situations that we talked about.
Exactly. And remember, even Graham himself,
Yeah.
he didn't start out as this master investor.
Right.
He honed his skills over decades.
Yeah.
Learning from his successes and his failures.
So essentially, he was constantly experimenting.
Yeah, he was always trying new things.
Yeah. Seeing what worked, what didn't work.
And he emphasized the importance of staying humble.
Absolutely.
Right.
Yeah. Humility is key in investing.
Because you're not always going to be right.
Exactly.
and like questioning your assumptions.
Yeah, don't be afraid to challenge your own beliefs.
And never stop learning.
The market is always changing.
Right.
There's always something new to learn.
It's like a lifelong pursuit.
It is, yeah.
You know, we've talked a lot about like the analytical side
Yeah.
of investing.
Yeah, numbers, the ratios.
Yeah, but there's another really crucial element, I think, that we haven't fully addressed.
What's that?
The psychological aspect.
Yes. The mental game of investing.
Yeah.
All those emotions.
Yeah, fear, greed, overconfidence. Yeah, all of those things.
Yeah, and those emotions can really sabotage your success.
Totally. And that's where DCA can actually be like a really helpful tool.
It could be a game changer because you're taking the emotion out of it.
You're not making those individual decisions based on fear or greed.
You're just following the plan.
Exactly.
So it's almost like you're putting up a wall between yourself and Mr. Market.
Right.
You're not letting his mood swings affect you.
Yeah. You're staying focused on your own goals.
Exactly. And I think that's so important.
Yeah.
Because the market is going to go up. It's going to go down.
It's a roller coaster.
Yeah. And you have to be able to like ride those waves without making like rash decisions.
And that's where having a clear investment philosophy and a well-defined strategy can really help.
Right. So when those doubts start to creep in, you can always go back to your core principles.
Exactly. Remind yourself of your long-term goal.
Yeah. And just stay the course.
And that actually brings us to what I think is like the biggest takeaway from this whole deep dive.
What's that?
This entire journey has been about empowering you, the listener, to take control of your financial future.
I like that.
Yeah. You know, we haven't given you all the answers.
Right.
But we've given you the tools and the insights and hopefully the inspiration to start making more informed decisions.
So it's not about like blindly following someone else's rules.
Exactly.
It's about like understanding it for yourself.
Yeah.
And then making the decisions that are right for you.
And ultimately achieving your own definition of success.
Yeah. And I think that's a really empowering message.
It is empowering.
So as we wrap up this deep dive,
I
want to leave you with one final thought.
All right, shoot.
What if you could take everything you've learned today and create something truly unique?
Oh, I like that.
Yeah.
Tell me more.
What if you could develop your own personalized investment approach that incorporates the best of these strategies, but it's also like tailored to your own goals, your risk tolerance?
Right. It's not about copying someone else's playbook. It's about creating your own.
Exactly.
Yeah.
And I think that's the real power of this whole process.
It's about asking the right questions.
Yeah.
And charting your own course.
I love that. So it's like we've given you the map. And the compass.
But now it's up to you to go out and explore.
Exactly. Discover and create your own path.
Love it.
To financial success.
And remember, don't be afraid to seek guidance along the way.
There are lots of great resources out there.
There are.
Lots of experts who can help you.
Absolutely.
Yeah.
So yeah, don't be afraid to reach out.
This has been an amazing journey.
Yeah.
I've learned so much.
Me too.
Thanks for joining us, everyone.
And happy investing. Welcome to another deep dive with us. Today we're going to try to combine two pretty interesting and powerful strategies, dollar cost averaging and Benjamin Graham's value investing principles.
Okay, yeah.
So whether you are prepping for a meeting or just kind of generally curious about these things, or maybe even looking to really level up your investing game, get ready for some insights.
I think what's really cool about this combination is that we can tackle two major hurdles that I think a lot of investors face.
Oh, yeah.
And that's managing their emotions and identifying true value.
Right. So dollar cost averaging is kind of like that mantra you repeat to yourself when market's just being crazy.
Yeah.
It's about investing a set amount regularly, regardless of the price.
Exactly.
So, for instance, one of our sources uses the example of investing $100 every single month.
Okay.
No matter if the share price is soaring or plummeting.
Yeah, it's taking the emotion out of it. Like you're not trying to time the market.
Right.
You know, even seasoned professionals, it's hard to do that.
Yeah.
And I think we actually have some data on that too. There was a 2020 study by Delbar Inc.
Okay.
And it found that the average investor actually underperformed the market.
Oh, wow.
Consistently.
Wow.
Because of emotional decision making.
Oh, interesting.
Often buying high and selling low.
Yeah.
Which is,
the opposite of what you want to do.
Yeah, the opposite of what you want to do. So this helps to sidestep that.
Yeah, so it takes the emotion out of it and lets you ride out that volatility.
Right.
Now, pair that with Benjamin Graham,
Yes.
who is considered the father of value investing.
Right.
And it gets really interesting.
Yeah.
So tell me about him.
Well, so he actually mentored Warren Buffett. And he was really good at uncovering what he called these hidden gems. And it wasn't about chasing the hottest trend. It was about identifying these companies that were undervalued,
Right.
that Mr. Market, as he called it, had unjustly overlooked.
Oh, interesting. Okay, so we have these two forces that seem very opposite.
Right.
We have the steady consistency with the dollar cost averaging, and then we have this opportunistic bargain hunting
Right.
using the value investing principle.
Exactly.
How do we even blend those two?
That's where the magic happens, I think.
Okay.
So you think of dollar cost averaging as your discipline, like the steady hand. And then value investing is your direction. It's your map.
Okay.
Leading you to these potentially lucrative opportunities.
I'm starting to see it.
Yeah.
I'm starting to see it. But wouldn't dollar cost averaging potentially slow down growth
Okay.
in a rapidly rising market?
Yeah. So that is a common misconception.
Okay.
Well, a lump sum investment might get you higher returns if the market's consistently going up.
Right.
Predicting market movement is notoriously difficult.
Right.
So dollar cost averaging smooths out your entry point
Okay.
over time, which can be really beneficial when you're dealing with potentially volatile value stocks.
Okay, so it's like a balancing act.
Yeah, like you're playing it safe, but also taking advantage of those dips.
Got it. Okay, so we're strategically entering the market while hunting for those gems.
Right.
But where do we find them? Where do we even begin to find undervalued companies?
So Benjamin Graham, he provides us a roadmap.
Okay.
And his approach is really centered around fundamental analysis.
Okay.
So you're digging deep into a company's financials to understand its true worth.
Okay.
One of his key principles was investing with a margin of safety.
Okay.
Essentially buying assets for significantly less than their intrinsic value.
That sounds so simple.
I know, it sounds really simple.
It sounds so simple. How do you do it, though? How do we actually determine that intrinsic value?
Yeah, so there's various metrics that he used.
Yeah, okay.
We'll dive into some of those later. But to illustrate this margin of safety, imagine a company with a really strong track record.
Yeah.
Consistent earnings, great balance sheet.
Okay.
And you determine that the intrinsic value is $100 a share.
Okay.
Now, if the market is valuing it at $60,
Okay.
that $40 difference
Yeah.
is your margin of safety.
That's like finding a designer dress on clearance.
Yes.
For a fraction of the price.
Exactly. You're getting a bargain.
Yes. A bargain. Okay, so do our sources give us any real-world examples of applying these principles?
They do. So one source actually provides specific criteria for identifying these defensive stocks. So these are companies in stable industries with consistent earnings, history of paying dividends.
Okay.
They're not really susceptible to these crazy market swings.
Hold on. Defensive stocks. Let's maybe unpack that a little bit.
Yeah.
What makes a stock defensive?
So think of these as the stalwarts of the market. These companies that are providing these essential goods and services that people rely on regardless of what's happening in the economy.
Right.
So for example, think of utility companies or consumer staples like food and beverage producers.
Right.
Because their earnings tend to remain relatively stable even during downturns.
It's like the difference between investing in a really trendy fashion boutique versus a grocery store.
Yes, exactly.
The grocery store is always going to have customers.
Exactly. And that consistency, those consistent earnings, that's what Benjamin Graham looked for.
Yeah.
Because that provides that measure of stability and predictability.
Right.
And another source actually uses a scoring system that's inspired by Graham's principles.
Okay.
And it's called the Net Hunter Core 7 scorecard. And this system focuses on identifying companies that are trading for less than their net current asset value.
Whoa. Hold on. Net current asset value. I need you to break that one down.
Okay. So imagine taking all of a company's liquid assets, so things they can quickly turn into cash. So inventory, accounts receivable, and then subtract their liabilities, so their debts. The remaining amount is their net current asset value.
So it's like what they have left over if they had a giant yard sale and paid off all their bills.
That's a great analogy. And so the net hunter approach is looking for companies that are trading below that. So essentially getting all their assets at a discount.
Okay. I like that. Okay. So we're using dollar cost averaging to buy these companies while the market is giving us these bargain prices.
Yeah.
Sounds like a recipe for success.
It does sound good.
However, we need to talk about risk management.
Yes, absolutely.
Because no strategy
Right.
completely eliminates risk.
Right.
But our sources offer some great insights on how to manage it effectively.
Yeah.
So what are some of those golden nuggets of wisdom?
One key principle I think is really important is staying within your circle of competence.
What does that mean?
So it means sticking to industries and companies that you understand, avoiding the ones that are outside of your expertise.
So don't go down that rabbit hole.
Yes, exactly.
If you don't know how to get back out.
Exactly. And one of the sources actually specifically mentions avoiding these certain investment types
Okay.
because they feel they're outside of their comfort zone. So financials, regulated entities, ADRs, real estate, and closed-end funds.
Don't play in a game if you don't know the rules, right?
Yeah, exactly.
Okay. What other risk management tips did our sources highlight?
So one that stood out to me was looking for companies that are engaging in share buybacks.
Okay.
So when a company repurchases its own stock,
Yeah.
that could be a strong signal that they believe that the stock is undervalued.
They're putting their money where their mouth is.
Literally, yeah. And then also high insider ownership.
Okay.
So when management has a significant stake in the company,
Okay.
their interests are probably aligned with yours.
Right.
So they're incentivized to make decisions that are going to benefit all the shareholders.
Okay, so I'm liking this risk management. It's like a safety net while we're on our treasure hunt for these gems.
Yeah.
So before we jump into like how these two work together, in practice, maybe we should pause here and just let all this sink in.
Yeah, sounds good. Let's give our listeners a moment to process everything before we move into the application of these strategies.
Sounds good.
Yeah. Okay, so let's pick up where we left off. I'm ready to see how we can actually merge DCA with Graham's value investing approach.
Okay, so imagine you've done your homework, right? You've used Graham's principles. You've unearthed this company that seems undervalued, a potential diamond in the rough.
Right.
Now, instead of going all in at once,
Okay.
you use dollar cost averaging to build your position over time.
So we're not putting all of our eggs in one basket at a single price.
Right, exactly. You're spreading your risk
Okay.
by purchasing shares at different price points
Okay.
over a period of time. And this helps to mitigate the impact of that short-term market volatility, which can be really pronounced with value stocks.
It's like we're weaving this safety net into our investment strategy.
Right.
But wouldn't that mean we could potentially miss out if the price suddenly shoots up? That's a valid concern. However, remember that value investing isn't about chasing those quick profits.
Right.
It's about identifying companies with those solid fundamentals
Okay.
that the market has mispriced.
Right.
And dollar cost averaging just helps us stay the course, even when those inevitable
Okay.
short-term fluctuations
Yeah.
arise.
I see how that long-term perspective really fits in.
Yes.
But how do our sources actually suggest we apply this combined approach?
Okay, so one source dives into those specifics of those defensive stocks we mentioned.
Okay.
They really emphasize companies with that long history of stable earnings, consistent dividend payouts, strong balance sheets.
So those solid companies.
Exactly, those solid, reliable.
Aren't as susceptible to those economic downturns.
Exactly, and they even provide some concrete metrics
Okay.
to look for, like a minimum level of annual sales, a healthy current ratio,
Okay.
a track record of dividend increases. So all these factors can provide a measure of confidence in a company's ability to weather those market storms.
So it's like a checklist for stability.
Yes.
Are there any specific examples of industries or companies that fit that defensive profile?
Yeah, absolutely. Think about utility companies.
Right.
People need electricity,
Right.
no matter what the economy is doing.
Yeah.
Or consumer staples like food and beverage producers.
Right.
These are essential goods that people continue to buy,
Right.
even during tough times.
Yeah, those are great examples. It's about identifying those steady earners
Exactly.
that provide that sense of consistency in an unpredictable market.
Right.
But I'm curious, do our sources delve into any other strategies for merging DCA
Yes.
with Graham's principles?
Yes. So one source focuses on that net hunter approach that we touched on earlier.
Okay. Yes.
And this strategy utilizes a scoring system. Yeah. And it's inspired by Graham's principles
Okay.
to identify companies that are trading below their net current asset value.
I have to admit, I'm still wrapping my head around this net hunter concept. Okay.
Can we revisit that and maybe flesh it out a little more?
Yeah, absolutely. So remember, we're essentially looking for companies whose market value is less
Okay.
than the sum of their liquid assets minus their liabilities.
Okay.
You're basically buying $1 for 50 cents.
Right, that margin of safety.
Exactly. And this source provides us with a scorecard, and it has specific criteria
Okay.
to help evaluate companies
Okay.
based on this net-net approach. So it's like having a treasure map leading to those
Like
potentially undervalued gems.
Right, so we're combining that disciplined consistency of DCA
Yes,
with this treasure hunt mentality
exactly.
of the net hunter approach.
Right. So imagine finding a company that meets the net criteria and then using dollar cost averaging to gradually build your position over time. You're spreading your risk while simultaneously taking advantage of potential price dips.
Yeah, I'm seeing how this combined strategy could be quite powerful. But I imagine it requires a certain level of patience and discipline, especially when things are crazy in the market. You're absolutely right. This approach isn't for those seeking quick wins.
Right.
It's about building wealth steadily over time
Okay.
by strategically investing in these undervalued companies
Okay.
with strong fundamentals. And that's where understanding your own investment personality comes into
Yeah.
play.
Oh, right. The know thyself principle.
Yeah.
But how does that factor into the equation when combining DCA with Graham's approach?
Well, if you're the type of investor who thrives on excitement and short-term gains,
Right.
this strategy might not be the best fit.
Right.
But if you're drawn to the idea of patiently accumulating assets
Oh,
and riding out those market fluctuations,
okay.
this approach aligns perfectly.
So it's about matching your investment strategy to your personality,
Yes,
your risk tolerance,
right.
and your overall goals.
Exactly.
It's not just about the numbers, it's about aligning with your own investing philosophy.
That's a great way to put it.
Right.
It's about finding an approach that allows you to sleep well at night, knowing that you're investing in a way that feels both financially and emotionally sound.
I'm feeling more and more like a savvy investor.
Yeah.
But before we wrap things up, we need to circle back to risk management.
You are absolutely right.
Because, while DCA and value investing provide this solid framework, we need to be mindful of the inherent risks involved.
Exactly.
So what are some key takeaways our listeners should keep in mind?
So one of the most valuable insights I gleaned from these sources is the importance of staying within your circle of competence.
Right, that idea of not venturing out into unfamiliar territory.
Yes.
But how do we actually define our circle of competence? How do we know what's inside and what's outside?
It's about being honest with yourself.
Yeah.
About your level of understanding.
Right.
What industries do you genuinely know?
Right.
What types of companies can you confidently analyze? And if you're struggling to grasp the fundamentals of a particular business or sector, it might be wise to just steer clear.
Even if it seems like a good opportunity.
Even if it seems like a great opportunity.
So knowing our limits.
Yes.
Not letting FOMO cloud our judgment.
Exactly. And remember, there's no shame in sticking to what you know best.
Yeah.
In fact, that's often the most prudent approach.
That makes sense. It's like sticking to trails, when you're hiking in unfamiliar terrain.
Yes.
So you don't get lost.
Right.
And end up in a precarious situation.
Exactly. And speaking of staying on track, another crucial aspect of risk management is diversification.
Oh, right. That classic, don't put your eggs in one basket advice.
Yeah.
But how does that apply to DCA and value investing? I mean, we're already focusing on this niche of undervalued companies.
Right, but diversification can take many forms. It's not just about the number of stocks you own.
Okay.
It's also about spreading your investments across different sectors and industries.
Yeah.
So even within the realm of value investing, you can diversify by choosing companies with varying levels of risk, different dividend yields, growth potential.
So we're building a portfolio that balances those core value investing principles with a healthy dose of diversification.
Exactly. And that leads us to another crucial point, and that's regularly reviewing and adjusting your portfolio.
Oh, okay.
The market's constantly evolving.
Yeah.
Companies can change over time. What might have been a solid value pick a few years ago could become less attractive as conditions shift.
So it's not a set it and forget it. We need to be actively engaged.
Exactly. You need to stay engaged. And that brings us to the final piece of the risk management puzzle. Understanding the psychological aspects of investing.
Oh, right. We talked about DCA and how that helps manage emotions.
Right.
But are there any other psychological traps?
So one common pitfall is something called confirmation bias.
What is that?
It's the tendency to seek out information that confirms our existing beliefs
Right.
and ignore evidence.
That contradicts it.
That contradicts it. This can be really dangerous when you're evaluating potential investments.
So we might convince ourselves that a stock is a great value pick
Exactly.
because it aligns with what we already believe.
Yeah.
Even if the
fundamentals don't support that.
don't support that.
Right. So it's really important to be objective in our analysis,
Yeah.
challenge our own assumptions,
Mm-hmm.
and be willing to change our minds
Yeah.
if the evidence suggests that we should.
It's like having a devil's advocate on your shoulder.
Exactly. And that's the beauty of combining DCA with that thoughtful,
Yeah.
research-driven
Right.
approach to value investing.
Okay.
It encourages us to be both disciplined and analytical, temper our emotions with logic and reason.
I like it. All right. I'm feeling more and more empowered to navigate this value investing world. But before we jump into our final takeaways, maybe we should pause and let all this sink in.
Sounds good to me. We covered a lot of ground in this episode, and I think our listener deserves a moment to process everything before we move on to our final thoughts.
Sounds good. And we're back, ready to distill all these amazing insights
Yeah.
into actionable takeaways. It's like we've been on this treasure hunt for investing wisdom,
We have.
and I feel like we struck gold.
Yeah, I think we've explored some pretty powerful concepts today. Combining dollar cost averaging with Benjamin Graham's value investing principles can really be a game changer.
Okay, so let's recap those key takeaways for our listeners.
Okay.
So first, we learned that dollar cost averaging takes the emotion out of investing.
Right.
It lets us ride out those market swings.
Yeah.
And then we dove into Graham's world, and we were trying to find those undervalued companies, those hidden gems.
Right. The ones that the market has overlooked.
And remember that margin of safety?
Yes.
Buying assets for way less than their intrinsic value.
Yes. Getting a bargain.
It's like finding those incredible deals at like a designer sample sale.
Mm-hmm.
Exactly. But instead of clothes, we're getting valuable companies.
Yes.
And third, and this is probably most important, we talked about understanding ourselves as investors.
Yes.
Risk tolerance, time horizon, our comfort level with different strategies
All these things.
shape our approach.
I like to think of it as like finding the perfect pair of shoes.
Yeah.
They might look great on somebody else, but if they don't fit your foot,
Yeah.
you're going to be miserable.
Right. So it's all about customizing, tailoring those powerful strategies to fit our individual needs. But before we send our listeners off on their investing journey, we should probably leave them with a question, something to ponder as they explore these concepts.
I have a question.
Okay.
If you had to pick one, just one key metric from Graham's value investing principles
Okay.
to focus on when selecting stocks for DCA, which would it be and why?
Ooh, that's a good one. So many possibilities. The price to earnings ratio?
Okay.
That's a classic measure of value. Or maybe the debt to equity ratio indicates a company's financial health. Or something else entirely. We'd love to hear your thoughts. Head over to our social media pages and let's keep this conversation going.
And remember, the journey of investing is an ongoing one, so there's always something to learn.
That's the beauty of it.
So keep learning.
It's all about growth, financially and intellectually.
Keep investing in your own knowledge.
Happy investing, everyone.
Yes. Until next time. All right, so get ready, because today we are going to dive deep into something really fascinating that you sent over.
Yeah.
This strategy that basically combines the world of like the classic value investing of Benjamin Graham with,
Right.
this idea of dollar cost averaging,
Yeah.
which sounds kind of like a mouthful.
It is.
But imagine this.
yeah.
Imagine knowing how to spot, those stocks, the hidden gems
Yeah.
that are trading for way less than they're actually worth, and then having a system
Right.
to actually like buy them consistently,
Yeah.
even when the market's going crazy.
Yeah, it's a really interesting combination because when you think about it, value investing and dollar cost averaging seem
Right.
like they're completely different.
Like from different planets almost.
Yeah.
Yeah,
But they can work really well together.
totally. And it's like, on the one hand, you've got, Benjamin Graham, like the godfather of value investing.
Yeah.
The guy who literally, I think, became a millionaire by the time he was 35,
That's right.
using these principles.
Yeah, his ideas are really powerful and they've stood the test of time.
They have.
I mean, even Warren Buffett, the Oracle of Omaha himself,
Right.
he credits a lot of his success to Graham's teachings.
Wow.
Yeah.
So what's the secret sauce then?
Well, one of the big things that made Graham different was his focus on what he called the margin of safety.
Margin of safety.
Okay,
Yeah.
so think of it like this.
Okay.
If you're buying a car and you get it for way less than it's actually worth,
Right.
then you've got this cushion, right?
Yeah.
If something goes wrong.
You got a deal.
Exactly. So Graham applied that same idea to stocks.
Interesting.
He always aimed to buy assets for much less than their real value. So he wasn't chasing after like the hot new thing,
Right.
It was looking for those overlooked opportunities, those companies that were maybe a little bit out of favor, but had strong underlying value.
So, okay, that makes total sense. But how do we actually find those hidden gem companies?
Right.
Is there like a treasure map or something?
Well, Graham did leave us with a set of tools, what you might call an investor's toolkit.
Right.
He came up with a bunch of ways to identify these undervalued companies using information that's actually pretty easy to find.
Okay.
It's like a detective, using clues to solve a case.
Yeah.
Except here, the clues are financial data.
Okay, I like that analogy. I'm following along.
Yeah, so one of the main tools he used was the price-to-earnings ratio.
The PE ratio.
Yes, the PE ratio.
Yeah, I've heard that term thrown around, but to be honest, I don't always know what it actually means.
Yeah, a lot of people don't. So it's a pretty simple idea, really. It compares a company's stock price to how much profit it's making per share. So basically it tells you how much investors are willing to pay for each dollar of earnings.
Okay.
Graham liked to look for companies with a low PE ratio.
Low PE.
Because it often meant they were undervalued by the market.
So like a low PE ratio could be a sign that maybe like the market is sleeping on this really great company.
Exactly. Graham was famous for this idea of what he called Mr. Market.
Mr. Market.
Yeah, he basically pictured the market as this kind of irrational character.
Oh, wow.
Who swings wildly between like extreme optimism and pessimism.
Oh, gosh. So kind of like a moody friend almost.
Yeah, exactly. Some days Mr. Market is like super excited and willing to pay way too much for your stocks.
Right.
And other days he's like doom and gloom and wants to sell everything for pennies.
He's got some serious mood swings, this Mr. Market.
Yeah, he does. But Graham's big insight was that these mood swings actually create opportunities for smart investors.
Interesting.
When Mr. Market is feeling down, that's when you can swoop in and buy those bargain stocks.
I see.
And when he's overly excited, maybe it's time to think about selling.
Got it.
But remember, we're not trying to perfectly time the market because that's basically impossible.
Yeah.
We're looking for those companies with good, solid fundamentals.
Okay, so ignore the hype and just focus on like the core value. Got it. Now, you mentioned earlier that the PE ratio is just one of the tools that Graham used.
Right.
What were some of the other things he looked at?
Another important one was the ratio of shareholder equity to total assets.
Shareholder equity to total assets.
Yeah. It's basically a way to measure how much of a company's assets are funded by ownership versus debt. So Graham liked companies with a high equity ratio because it meant they were financially strong and not overly reliant on borrowing.
So like a strong equity ratio means a company is kind of built to withstand a storm, so to speak.
Yeah, exactly. He looked for a ratio of at least 50%.
50%.
Which meant the company had twice as much equity as debt.
Okay.
At least.
So even with all these metrics, it still feels a little bit like looking for a needle in a haystack,
Yeah.
Like, how do we make sure we're not just randomly picking stocks?
Well, for the PE ratio, Graham had a specific rule of thumb.
Okay.
He recommended that investors look for stocks whose price is no more than 7 times their current earnings.
Okay. 7 times earnings. So that's like our starting point.
Yeah.
The first clue in this treasure hunt for these undervalued companies.
Yeah, exactly. It's one of the many clues we can use. And the best part is that you can find all this information in places like the Wall Street Journal.
Right.
You don't need access to some secret database.
That's good to hear. I'm feeling a lot less intimidated by all this financial stuff.
Good.
So we've got these metrics to help us spot these undervalued companies. We're tuning out Mr. Market's, mood swings, and we're looking for those companies with solid fundamentals.
Yeah.
So then what's the next step?
That's where dollar cost averaging comes in. It's like your secret weapon for staying disciplined and taking advantage of opportunities, even when things get a little scary in the market.
Yeah.
All
right. Let's dive into that then.
Okay.
Okay. So we've got Graham's principles, but where does this dollar cost averaging thing fit in?
Yeah.
It sounds almost too easy, like you just set it and forget it.
Yeah, it kind of is in a way. The whole point is to take the emotion out of investing
Okay.
and stick to the plan,
Mm-hmm.
even when the market is, doing crazy things.
Right.
Remember Mr. Market, our friend with the mood swings?
Yeah.
Well, with dollar cost averaging, we're not letting his little tantrums,
Affect us.
affect us. Exactly.
So we're not trying to time the market. We're just consistently investing,
Exactly. You got it.
no matter what's happening.
And because you're investing regularly, you naturally buy more shares when prices are low
Okay.
and fewer when they're high.
Makes sense.
So over time, this brings down your average cost per share.
So it's like stocking up, when your favorite cereal goes on sale or something.
Exactly. You got it.
You're getting a better deal.
You're getting a better deal.
But does that mean we're just blindly throwing money at any stock?
Oh, no.
Is there still some analysis involved?
Absolutely. Dollar cost averaging doesn't replace analysis. It's more about staying disciplined, but it becomes really powerful when you combine it with those Graham principles for picking the right companies.
So it's like we're being consistent, but we're also being really picky
Exactly.
about what we're buying.
We want to make sure we're investing in quality,
Right.
not just, anything.
Yeah.
And actually, one of the sources had this really interesting case study
Yeah.
that I think shows this point perfectly.
Okay.
It was about a company called Albemarle and Bond Holdings.
Albemarle and Bond. Okay.
So at first glance, it looked like a classic Graham bargain.
Really?
It was trading at a huge discount to its net current asset value,
Okay.
which is something value investors look at.
So it seemed like a good deal.
Yeah, it seemed like a steal.
Wow.
But then when you dig deeper and apply some of those other Graham principles,
Mm-hmm.
you start to see some problems.
Like what?
Well, for one thing, the company had a lot of debt,
Oh.
and it was burning through cash really fast.
No, that's not good.
No, it's not. So it's kind of like, when you see a used car being sold for a ridiculously low price.
Right. There's probably something wrong with it.
Exactly. You got to wonder why it's so cheap.
Right. Yeah.
And unfortunately, in the case of Albemarle and Bond,
Yeah.
those warning signs turned out to be very real.
What happened?
The company ended up filing for bankruptcy,
Oh, no.
and a lot of people lost money.
So even with the system, we can't just assume everything's going to be okay.
Yeah, you always got to do your homework.
Right.
Dollar cost averaging helps you buy consistently, but Graham's principles help you pick the right companies.
I
You
see.
want to find those undervalued companies
Mm-hmm.
that have the potential to really grow over time.
So it's about combining discipline with quality.
Exactly. You got it.
Okay, that makes a lot of sense.
Good.
So let's say we've done our research. We found some promising companies using these Graham ideas, and we're ready to start investing.
Yeah.
Are there any tools out there that can help automate this whole thing?
You're in luck.
Really?
One of your sources actually talks about this.
Oh,
There
wow.
are all these online platforms and what are called robo-advisors.
Robo-advisors?
Yeah.
That sounds futuristic.
It is pretty cool.
What do they actually do?
Basically, they're like automated investing assistants.
Oh, wow.
They use algorithms to build and manage your portfolio based on your goals and how much risk you're comfortable with.
Interesting.
And some of them even let you set specific criteria based on Graham's principles.
So it's like having a little mini Graham working for you 24/7.
Well, not quite.
Okay.
You still need to understand how the tools work
Right.
and monitor your investments.
Got it.
But they can definitely take a lot of the work off your plate.
Okay, so it's like having a personal trainer. They can guide you, but you still have to put in the effort.
That's a great analogy.
Now, before we get too carried away with all these tools and strategies,
Yeah.
I think it's important to remember, what kind of investor are you?
Exactly. One of your sources really stressed that you got to know yourself before you jump into any strategy.
It's like trying to fit a square peg in a round hole.
Yeah, exactly.
If it doesn't align with you, it's not going to work.
So the question is, are you someone who enjoys researching companies and picking stocks?
Right.
Or do you prefer a more hands-off approach?
Yeah. Some people thrive on that hands-on stuff,
Right.
while others just want to set and forget it.
Exactly. And the source actually had some great advice for different types of investors.
Oh, cool.
So for people who want to keep it simple,
Yeah.
they recommend starting with blue chip stocks or index funds.
Okay.
Blue chip stocks are those big, well-established companies that have a long history of doing well.
Right.
And index funds let you invest in a bunch of stocks at once
Okay.
that track a specific market index.
So you're kind of spreading your risk.
Exactly. It's called diversification.
Diversification, got it.
Yeah. So even if you're not a financial expert,
Mhm.
you can still get started with investing Right. And hopefully benefit from the market's growth over time.
Okay, so we've got blue chips and index funds for the more passive investor.
Right.
What about those who are a little more adventurous?
Yeah, good question.
They want to maybe get their hands a little dirty.
Well, that's where what are called defensive grade stocks come in.
Statistic grade, okay.
Yeah, remember those Graham clues we talked about?
Yeah.
Consistent earnings,
Mm-hmm.
a history of paying dividends,
Okay.
a strong balance sheet.
Got it.
Those are all signs of a defensive stock.
So these are companies that are built to last.
Exactly.
No matter what the market throws at them.
They tend to be less volatile.
Okay.
And offer a good balance between risk and reward.
And the source had some specific steps for actually finding these companies.
Yeah, it was really interesting.
So you're basically using Graham's wisdom, but in a more focused way.
Exactly.
This is making a lot of sense now.
Good. I'm glad.
So we've got, blue chips and index funds for the set it and forget it investor, defensive stocks for those who are a little more hands-on. But what about those who are really like those enterprising investors? The ones who are ready to really dig in and do the research.
It's the source had something for them, too.
Okay.
They called them enterprising grade stocks.
Okay. Enterprising grade.
These are companies that have the potential for higher returns.
Interesting.
But, of course, they also come with more risk.
Higher risk, higher reward.
Exactly. So they require a deeper level of analysis. And you really got to be willing to monitor your investments closely.
So it's like venturing into uncharted territory.
Yeah, it's kind of like that.
Looking for hidden treasure.
You're trying to find those companies that the market might be overlooking,
Right.
but that have the potential to be huge.
It sounds exciting, but maybe not for everyone.
Yeah, it's not for the faint of heart.
So it sounds like we've got a Graham approach for every kind of investor.
I think so.
From passive to really hands-on.
Yeah, and it's not about finding a one-size-fits-all solution.
Right.
It's about finding what works for you.
Exactly.
Your goals, your risk tolerance, your personality.
Yeah, tailoring it to you.
Exactly.
Going through all this stuff, it really hits me that it doesn't matter what kind of investor you are.
Yeah.
There's this like underlying theme.
I agree.
Of, like you said, discipline.
Yeah. Consistency.
Not trying to time the market, just, doing the work.
Right.
And it seems like that's where this whole like Graham approach meets this dollar cost averaging.
Yeah, they work really well together.
Really shines.
Because you've got the system and you're sticking with it.
Right.
Even when Mr. Market is freaking out.
Which he does.
Which he does all the time.
All the time, yeah.
But you're not letting him, control you.
We're not letting him get to us. We're making smart decisions.
Right.
Based on, solid research.
Right.
Thinking long term.
Exactly.
We're not just like reacting to every little thing.
It's about focusing on the signal.
The signal.
Yeah.
Not the noise.
I like that. And one of the sources had this really cool analogy.
Okay.
They said investing is like planting a tree.
Okay.
You pick the right spot. You take care of it.
Yeah.
You give it time to grow.
Yeah.
And eventually it'll bear fruit.
Right.
But you don't dig it up every day.
Right.
To check on the roots.
Yeah.
You trust the process.
Trust the process. I like that.
Yeah.
Speaking of trusting the process.
Yeah.
I saw a couple of like little investing mantras.
Oh, yeah.
That I thought were kind of funny.
Like what?
I don't know if you've seen these, but like...
Tell me.
One of them was HODL.
Oh, yeah.
Which I was like...
That's a classic.
What does that even mean?
It means hold on for dear life.
Hold on for dear life.
It's like that internet slang.
Oh, okay.
Yeah.
Like don't panic, sell.
Exactly. Don't panic.
Just ride it out.
Yeah.
When the market dips.
The dips are going to happen.
They always happen.
Right.
That's part of it.
Okay.
And actually, often those dips are a good opportunity.
To buy when things are cheaper.
Okay, so that leads us to the other mantra I saw.
Okay.
Which was like, stay cool.
Yeah.
Buy the dip.
Buy the dip?
It's like your favorite store having a sale.
Exactly.
You don't freak out, you get excited.
It's a good time to stock up.
It's a good time to stock up.
Yeah.
I have to say, I'm feeling a lot less intimidated by investing now.
I'm glad to hear that.
We've got, these principles from this master investor.
Yeah.
We've got a system for being disciplined.
Yeah.
And we've got like these fun little mantras.
Yeah, it's all coming together.
Yeah.
So what's next?
Well, that's really up to you.
True.
Right? Because the real journey begins now.
That's right.
Like we've been given all the tools and information.
The ingredients.
And now it's time to kind of like create our own masterpiece.
I like that analogy a lot.
So what do you think?
I think it's been a really great deep dive.
Yeah.
We've learned so much about, Graham and dollar cost averaging.
Yeah, combining those two.
I think you're going to do great.
Well, I think we both are.
Yeah.
But the learning doesn't stop here.
right? Oh, definitely not.
Think about, what we've talked about today. What kind of investor are you?
Yeah.
What are your goals?
What are you trying to achieve?
And how can you use all this stuff to build a portfolio that's not just going to, survive,
Right.
but really thrive?
That's the challenge and the opportunity.
It's a journey.
It is.
Well, on that note, we'll wrap up this deep dive.
Sounds good.
As always, huge thanks to you, our amazing listener.
Yes, thank you.
For joining us on this journey of knowledge and discovery.
Yeah?
We'll be back soon with another fascinating topic, so stay tuned.
Yeah, looking forward to it.
And until then, keep exploring, keep learning, and keep diving deep.
All right, so we're diving into investing today.
Sound good?
Specifically, value investing and dollar cost averaging.
Okay.
And how to actually use them for long-term wealth.
All right.
You've given us a really interesting set of materials to work with this time.
Yeah.
Your notes on implementing these strategies, some articles explaining concepts like margin of safety and DCA, and even some success stories from investors who have actually put these ideas into practice successfully.
Cool.
So our mission is to help you figure out how to approach the market with a value-focused mindset, just like Benjamin Graham, making smart decisions based on what a company's actually worth, not just speculation.
Right.
Basically, we want to help you build a portfolio that reflects your investment personality. So to start, can you give us some background on what value investing actually is?
Sure. Value investing, as pioneered by Benjamin Graham, basically boils down to buying stocks that are trading for less than they're actually worth. Yeah. It's like finding those hidden treasures the market hasn't fully recognized yet.
Okay, so this whole idea of buying a dollar for 50 cents really intrigues me. But how do we actually find those opportunities in today's market?
That's where the fundamental analysis comes in.
Yeah.
You have to really look into a company's financials, scrutinizing their earnings, their assets, their debt, and their future growth potential. It involves looking at certain metrics, like their price to earnings ratio, the PE ratio.
Okay.
In your notes, you highlighted a PE ratio of 7.
Right.
That's a great starting point.
Yeah, and one of the articles even mentioned adjusting that PE ratio based on bond yields. I found that connection to the broader economy fascinating. How exactly does that work?
So bond yields basically reflect the overall cost of borrowing in the economy. By comparing a company's PE ratio to the prevailing bond yields, you can kind of get a sense of whether its stock price is truly undervalued relative to the broader market.
Right.
It adds that extra layer of analysis.
So we're not just looking at a number in isolation.
Right.
We're also considering the bigger economic picture as well.
Exactly.
Now, one source I found especially interesting talked about Graham's concept of margin of safety. Can you break that down for us?
Yeah, margin of safety is absolutely essential in value investing. It's that difference between a stock's market price and its intrinsic value, which is the price it should be trading at. Think of it as a cushion that protects you from unforeseen events or maybe errors in your analysis.
So it's like a safety net.
Exactly.
If the market takes a downturn or if we misjudged a company's prospects, that margin of safety helps minimize potential losses. I've even heard it described as like buying a dollar for 50 cents.
That's exactly it. And the beauty of margin of safety is that it forces you to be conservative in your valuations. You're not just looking for a good deal. You're looking for a great deal, one that offers a significant buffer against all the uncertainty.
Okay. Now, one of the sources used a really vivid analogy to illustrate this, the story of Mr. Market.
Right.
Can you walk us through that?
Yeah. Yes, Mr. Market. He's this whimsical character that Graham actually created to represent the emotional swings of the market.
Okay.
So every day, Mr. Market comes along and offers to buy or sell you stocks driven by fear or greed or other irrational impulses.
Gotcha. So how can we as investors use this understanding of Mr. Market to our advantage when we're building our portfolios?
By recognizing that Mr. Market's moods are often totally detached from reality, we can actually exploit his irrationality. So when he's overly pessimistic, offering to sell us valuable stocks at bargain prices, that's our opportunity. And when he's overly optimistic, bidding at prices beyond reason, we can resist that temptation to chase the hype.
That's a great point. It reminds us that the market isn't always rational, and that recognizing those moments of irrationality can be key to successful value investing. Now let's get into some specific metrics that can actually help us uncover these hidden gems. You mentioned the PE ratio earlier. What are some other metrics that value investors commonly use?
Another important one is the price-to-book ratio, or PB ratio.
Okay.
This compares a company's market value to its book value, which is essentially the value of its assets minus its liabilities. It's a measure of how much investors are willing to pay for each dollar of a company's net worth.
So if a company's PB ratio is low, that might indicate that the market is undervaluing its assets.
Exactly. And there's another interesting metric that caught my eye, the net current asset value, or NCAV.
Okay.
One source suggested focusing on companies trading below their NCAV. This means looking for opportunities where the market is valuing the company at less than its readily available assets, like cash, inventory, and receivables.
So in essence, we're looking for companies whose stock price is so low that we could theoretically buy the entire company, liquidate its assets, and walk away with a profit.
Precisely. Now, it's not always that simple, of course. There are often reasons why a company might be trading below its NCAV. It could be facing some operational challenges. Maybe it has a high debt load, or it operates in a declining industry.
That reminds me of the anecdote from one of the sources about a company called Albemarle and Bond Holdings. They were trading at a massive discount, but they also had a mountain of debt and a struggling business model. It's a cautionary tale, reminding us that even a statistically cheap stock still requires careful scrutiny.
Absolutely. Numbers can only tell you so much. You have to understand the business itself, its competitive landscape, and its long-term prospects. It's about combining that quantitative analysis with some qualitative judgment.
One approach that really resonated with me is the net working capital strategy. Can you give us an overview of that?
Sure. It's kind of a more stringent version of focusing on NCAV. You're basically looking for companies where the market cap is less than their net current assets minus all liabilities. This is a very conservative approach that could really help you identify those companies with a significant margin of safety.
So it's like adding an extra layer of protection by ensuring that even if the company had to liquidate its assets to pay off all its debts, you would still come out ahead.
Precisely. It's a strategy that emphasizes that capital preservation and minimizes downside risk. Of course, like any investment strategy, it requires thorough research and analysis to find those rare opportunities where the market is truly mispricing a company's worth.
Now, all this talk about analyzing financials and calculating ratios might seem a little daunting to someone who's new to investing. Are there any simpler ways to get started?
Absolutely. One approach is to focus on well-established blue-chip companies with a long history of stable earnings and dividend payments. These are companies that have weathered economic storms before, and they're likely to continue paying those dividends even during tough times.
So instead of trying to find those deeply undervalued hidden gems, we could start by building a portfolio of these more reliable, what did we call them, steady Eddie companies.
Exactly. And Graham himself actually recognized that not all investors have the time or inclination to become like expert stock pickers. He distinguished between two types of investors, defensive and enterprising.
So who are these defensive and enterprising investors, and how do their approaches differ?
So the defensive investor, as the name suggests, is primarily concerned with preserving capital and minimizing risk. They're not looking for high-flying growth stocks or speculative ventures. They're seeking out those steady, reliable companies that can provide consistent returns over the long term.
That makes sense. What about enterprising investors? Are they the ones who are more comfortable taking risks? In pursuit of higher returns?
Precisely. Enterprising investors are willing to roll up their sleeves, do more in-depth research, and maybe invest in companies that are less established, or maybe even facing some temporary challenges. They're really looking for those hidden gems that have the potential to become the next market leaders.
So while a defensive investor might be content with a portfolio of well-known, established companies,
Hmm.
an enterprising investor is digging into those lesser-known companies
Right.
on the cusp of innovation.
Yeah.
Almost like venture capitalists in the stock market,
Exactly.
looking for that next big thing.
And just like Graham had those criteria for defensive stocks,
Okay.
he also provided guidance for enterprising investors.
Mm.
He understood that companies with higher growth potential often carry more risk,
Right.
but he still emphasized investing in businesses with a clear track record
Okay.
and a solid plan for the future.
So it sounds like there's a value investing approach for everyone,
Yeah.
regardless of their risk tolerance
Hmm.
or their investment personality. Now, let's shift gears a bit and talk about dollar cost averaging, or DCA.
Sure.
This is another concept you mentioned wanting to explore,
Yeah.
and I think it ties in nicely
Right.
with value investing.
Dollar cost averaging is a powerful strategy
Okay.
that can complement value investing beautifully.
Can you give us a quick rundown of what DCA is all about?
Sure. Dollar cost averaging is simply the practice of investing a fixed amount of money
Yeah.
in a particular asset at regular intervals,
Mm-hmm.
regardless of the asset's price.
Mm.
It's like setting up a systematic investment plan
Right.
where you're automatically buying a certain number of shares or units of a
Okay.
stock or fund each month, no matter what the market's doing.
So, as it's low, you buy more shares.
Exactly.
That seems like a good way to ride out
Yeah,
those inevitable market fluctuations.
it is. And by consistently investing over time, you're essentially averaging out your cost basis,
Okay.
which can potentially lower your overall purchase price
Mm-hmm.
and reduce the impact of that market volatility on your portfolio.
One source mentioned that DCA is a great tool for managing
Yeah.
the buy the dip mentality. Instead of trying to time the market perfectly and
Mhm.
risking buying at the wrong time, you're spreading out your purchases over time and
Yep.
capturing those dips along the way.
DCA takes the emotion out of investing,
Okay.
and it helps you stay disciplined,
Mm-hmm.
even when the market is turbulent.
Right.
It's a strategy that aligns perfectly with that long-term mindset of
Yeah.
value investing.
This makes a lot of sense. So DCA is all about removing the guesswork,
Uh-huh.
taking advantage of those dips, and sticking to a consistent plan. But one thing I'm curious about is how DCA might impact our returns,
Yeah.
especially if the market is trending upwards. Some people argue that a lump sum investment might outperform DCA
Mm-hmm.
in a consistently rising market. How would you respond to that concern?
That's a valid concern.
Yeah.
It's true that in a hypothetical scenario where the market just goes straight up,
Right.
a lump sum investment made at the very beginning might yield higher returns
Yeah.
than DCA.
Yeah.
However, in the real world,
Mhm.
predicting market direction with certainty
Right.
is impossible.
So it's a trade-off between potential higher returns with a lump sum investment
Yes,
versus potentially lower risk and more consistent growth with DCA.
precisely. DCA prioritizes that risk management
Yep.
and consistent growth over trying to time the market perfectly.
Mhm.
It aligns with those core principles of value investing:
Mm-hmm.
patience, discipline, and a focus on long-term value creation.
Right. So we've got these two powerful concepts, value investing and dollar cost averaging.
Yeah.
Now, the big question is, how do we combine them to build a portfolio that reflects our individual investment personality and helps us actually achieve our financial goals?
That's a great question, and one we'll explore
Okay.
as we continue our deep dives.
Yeah.
But before we move on, I want to circle back to
Yeah.
the point you raised earlier about feeling overwhelmed by
Yeah.
all the financial metrics and analysis.
Right. It can definitely feel like information overload,
It can.
especially for someone who's just getting started with investing.
Absolutely.
Oh,
And that's why it's so crucial to start with a solid understanding of the fundamental principles and then gradually build your knowledge from there.
so baby steps.
Yeah,
Focus on the basics.
exactly.
And don't get bogged down in the minutia.
Remember, investing is a journey, not a destination.
Okay.
And the more you learn, the more you realize there's always more to learn.
Right.
But starting with the right foundation can set you up for success in the long run.
That's reassuring.
Yeah.
So where do we go from here? How do we actually take these concepts of value investing and DCA? Right.
And start putting them into practice.
That's a great question, and one we'll tackle head on
Yeah.
in the next part of our deep dive.
Sounds good.
We'll explore specific strategies for actually identifying those undervalued stocks,
Okay.
incorporating DCA, and building a portfolio that aligns with your own unique investment personality.
Awesome. I'm looking forward to digging deeper.
Me too. Hashtag TTS, the deep dive episode 2025-0209, part 2 of 3. So we've laid the groundwork for understanding value investing and dollar cost averaging. Now let's talk about how to actually put these concepts into action
Okay.
and build a portfolio that reflects your individual goals and risk tolerance.
That's what I'm excited to get into. Where do we even begin?
Well, a great starting point is to consider your investment personality.
Okay.
Are you more drawn to the slow and steady wins the race approach of a defensive investor, or the seek out the hidden gems style of an enterprising investor?
I've always kind of admired those investors who can spot those under-the-radar companies.
Yeah, that eventually become those market leaders.
Right.
But I also really appreciate the value of stability and those consistent returns.
Exactly. And understanding where you fall on that spectrum can really guide your portfolio construction.
Okay.
So let's say you identify more with that defensive investor personality.
Okay.
Their focus is on minimizing risk and building a portfolio that can withstand that market turbulence.
So they'd probably gravitate towards those blue chip companies we discussed earlier.
Yes.
The ones with a long track record of stable earnings and dividend payments.
Precisely. Think as companies with strong brand recognition, a history of navigating those economic downturns, and a commitment to sharing profits with their shareholders.
Okay.
These are the cornerstones of a defensive portfolio.
And how would a defensive investor actually approach DCA?
Yeah.
Would they use it differently than an enterprising investor?
The beauty of DCA is its adaptability.
Okay.
For a defensive investor, DCA can be a fantastic way to consistently build a position in those blue chip companies, taking advantage of any dips in the market
Right.
without having to try and time it perfectly.
Yeah.
It's like setting up a system that automatically buys more of those reliable companies
Okay.
whenever they go on sale.
That makes sense. It takes the emotion out of it and allows the defensive investor
Right.
to just steadily accumulate shares over time.
Exactly.
Now, what about the enterprising investor?
Yeah.
How would they approach portfolio building?
Their portfolio would likely have a bit of a different flavor.
Okay.
Remember, enterprising investors are more comfortable with risk
Right.
and actively seek out those companies with higher growth potential. They might target
Okay.
specific sectors or industries they believe are poised for significant expansion.
Right.
They're looking for those companies that might not be household names yet, but have the potential to disrupt their industries and generate those substantial returns.
So while a defensive investor might be content with a portfolio of well-known established companies, an enterprising investor might be digging into those lesser-known companies, the ones on the cusp of innovation.
Exactly.
They're more like those venture capitalists in the stock market looking for the next big thing.
And just like Graham had criteria for defensive stocks, he also provided guidance for enterprising investors.
Okay.
He understood that companies with higher growth potential often carry more risk,
Right.
but he still emphasized investing in businesses with a clear track record and a solid plan for the future.
So for an enterprising investor, it's about finding that sweet spot between risk and reward.
Exactly.
They're willing to do the research, analyze those financial statements, and seek out those hidden gems that have the potential to become market leaders.
Right.
But how would they use DCA to build a portfolio of these potentially more volatile companies?
DCA is a valuable tool for enterprising investors as well. It allows them to gradually build positions in those potentially volatile high-growth companies, smoothing out the ups and downs that inevitably come with investing in those emerging markets or innovative sectors.
Okay.
They're still using DCA to manage risk and potentially lower their average cost per share, even though they are comfortable with that higher overall risk profile.
This is where it gets really interesting to me, seeing how both defensive and enterprising investors can utilize DCA to achieve their goals.
Right.
But one question that pops into my mind is, how many stocks should we actually aim for in our portfolio? I've heard everything from 10 to 30 to even 100.
Right.
What are your thoughts on that?
That's a great question, and it really depends on your individual circumstances. The amount of time you're willing to dedicate to research and management and your comfort level with tracking multiple positions. While diversification is key to managing risk, it's also important to make sure you can effectively monitor and understand each investment in your portfolio.
So it's not just about blindly following a magic number. It's about finding that balance between diversification and manageability.
Exactly.
Yeah.
A well-researched portfolio of 20 stocks might be more valuable than a hastily assembled collection of 50. It's about quality over quantity. You mentioned earlier that one of your notes suggested aiming for a portfolio of at least 30 stocks.
I was curious if that aligns with Graham's recommendations
Yeah.
or if it's just a general rule of thumb.
Well, Graham recommended a minimum of 10 stocks for diversification,
Okay.
but he acknowledged that having 30 or more could provide even greater protection against that volatility.
Okay.
It's about spreading the risk and ensuring that the performance of any single company
Right.
doesn't disproportionately impact your overall portfolio.
That makes a lot of sense. It's
Yeah.
about not putting all your eggs in one basket,
Right.
even if it's a seemingly sturdy basket.
Exactly.
Now let's talk about managing risk within our portfolio. What are some key strategies
Right.
that both defensive and enterprising investors should
Yeah.
keep in mind?
One of the most important strategies is to continuously monitor and rebalance your portfolio.
Yeah.
The market is constantly evolving, and your portfolio needs to adapt accordingly.
Okay.
This might involve selling stocks that have reached your target price,
Mm-hmm.
trimming positions that have become overweighted,
Right.
or adding new investments that align with your evolving investment thesis.
So it's not a set it and forget it approach.
No.
We need to stay engaged and adjust our portfolio as needed
Right.
based on market conditions and our individual goals.
Absolutely. Value investing requires ongoing research, analysis, and adjustments.
Right.
It's an active strategy that demands you stay informed
Mm-hmm.
and make those informed decisions based on what's happening in the market and how your holdings are performing.
Okay. You also mentioned in your notes avoiding certain types of companies,
Oh, yeah.
like financial institutions,
Mhm.
real estate, and closed-end funds.
Right.
Is that a wise approach
Yeah.
for someone starting out with value investing?
It's not uncommon for value investors, especially those starting out, to focus on areas they understand well.
Mm-hmm.
If you're not familiar with the intricacies of a particular industry or asset class,
Right.
it's generally prudent to steer clear
Yeah,
until you've gained more knowledge and experience.
that makes sense. It goes back to that idea of investing within your circle of competence,
Exactly.
focusing on areas where you have a deeper understanding and can make more informed judgments. I also noticed in my notes an emphasis on companies buying back their own stock.
Okay.
Can you explain why that's a positive signal for value investors?
Certainly. When a company buys back its own stock, it's essentially reducing the number of
Okay.
outstanding shares.
Yeah.
This can actually increase earnings per share
Mm-hmm.
and potentially boost the stock price. It can also signal that management believes
Right.
that their stock is undervalued and they're taking steps to enhance shareholder value.
So it's like the company's putting its money where its mouth is, signaling confidence in its own future prospects.
Exactly.
That's definitely a reassuring sign for a value investor. I also noticed you mentioned insider ownership as
Right.
a factor to consider. What's the significance of that?
When insiders like executives or board members are buying shares of their own company,
Okay.
it can indicate that they believe the stock is undervalued and expect the price to rise. It's a strong vote of confidence from those who know the company best.
So it's like getting a behind-the-scenes glimpse into the company's potential.
Yeah.
They're putting their own money on the line,
Right.
so they must believe in the company's future. That makes a lot of sense. Now, we've talked a lot about the analytical aspects of value investing, but I think there's another crucial element that often gets overlooked: patience.
You're absolutely right. Patience is a virtue in many aspects of life,
Yeah.
but it's especially crucial in value investing. Remember, it's not about getting rich quick.
Right.
It's about identifying those undervalued assets and waiting for the market to recognize their true worth. That can take time, sometimes even years.
So it's about resisting that urge to chase short-term gains and
Yeah.
staying focused on the long-term potential of our investments.
Exactly. Value investing requires discipline
Okay.
and a willingness to ride out the inevitable ups and downs of the market. It's about trusting your research, your analysis, and your investment thesis,
Yeah.
and it's about not panicking
Right.
when the market inevitably dips or corrects.
One of the sources I came across used the phrases "hold on for dear life," HODL, and "stay cool and buy the dip," BTD,
I love those.
to capture that sentiment.
Yeah.
It's about not letting those short-term fluctuations
Right.
shake your conviction.
I love those phrases.
Yeah.
They perfectly capture the essence of a value investor's mindset.
Yeah.
It's not just about waiting passively. It's about having the courage to stick to your strategy.
Yeah.
Even when the market seems chaotic. It's about remembering that value investing is a marathon, not a sprint.
Now, one of the things that intrigues me about value investing is this idea of identifying catalysts,
Yeah.
those events or situations that can trigger a significant change
Right.
in a company's valuation.
Yeah.
Can you talk a little bit about that and
Yeah.
why it's relevant for value investors?
A catalyst can be anything from a new product launch to a merger or acquisition,
Okay.
a change in management, or even a shift in those industry trends.
Mm.
Value investors often look for catalysts as a way to potentially accelerate the realization of a company's intrinsic value.
So it's like a spark that ignites the value of a company and
Yeah.
propels its stock price higher.
Right.
They're not just passively waiting.
Right.
They're actively seeking out those situations where the market is likely to reassess a company's worth. But finding those catalysts must require a really deep understanding of the company, its industry, and the broader market, right?
Absolutely. It's not simply looking at past performance. It's about understanding the future potential and identifying those factors that could drive that significant change.
Right.
You have to connect the dots and anticipate how those factors might impact the company's valuation.
Okay. So we've talked about diversification, risk management, patience, and catalysts.
Yeah.
Are there any other key ingredients in the value investing recipe for success?
One element we haven't touched on yet is the importance of emotional discipline.
Okay.
Remember, value investing is a contrarian approach. It often requires buying stocks that others are selling,
Right.
going against that herd mentality. It's not just about being rational with your analysis.
Okay.
It's about managing your emotions
Right.
and not getting swept up in that market hype or fear.
So it's about staying grounded, sticking to your strategy,
Yeah.
and not letting your emotions dictate your investment decisions,
Wow.
especially when the market's going crazy.
Yeah, it's easy to get caught up in the frenzy.
Right.
Emotional discipline is about remembering that the market is often driven by emotions in the short term.
Okay.
But value will ultimately prevail in the long run.
Right.
It's about having the conviction to buy when others are fearful and the discipline to sell when others are greedy.
It sounds like achieving that level of emotional discipline takes time,
It does.
practice, and maybe even a few bumps along the way.
Absolutely. It's a journey, not a destination. Every investor will face challenges and make mistakes along the way. The key is to learn from those experiences,
Right.
refine your approach, and stay committed to those principles of value investing.
Okay.
It's about embracing the learning process and recognizing that investing is an ongoing journey
Yeah.
of self-discovery and adaptation.
You mentioned earlier that value investing often involves buying stocks that are facing temporary challenges.
Yes.
How can we actually distinguish between a temporary setback and a sign of deeper trouble?
Yeah,
What are those warning signs we should be looking out for?
that's an excellent question, and it's one of the trickiest aspects of value investing. We're not simply looking for cheap stocks. We're looking for undervalued companies
Right.
that have the potential to overcome their current challenges and thrive in the long run.
Okay.
We need to figure out if a company has stumbled but still has the strength to get back up, or if it's facing some fundamental flaws that are unlikely to be resolved.
So how do we go about making that distinction? What are some key factors to consider?
It all starts with conducting thorough due diligence.
Okay.
We need to dig deep into the company's financials, understand its business model, assess its management team, and evaluate its competitive landscape.
Okay.
We need to be confident that the company's problems are solvable
Right.
and that its long-term prospects are still intact.
So it's not about catching falling knives. It's about identifying those companies that have the resilience and resources to bounce back from adversity.
Exactly.
What are some specific red flags that might signal deeper trouble?
One major red flag is a consistent decline in revenue or earnings over an extended period. This could indicate a fundamental problem with the company's products or services, its market positioning, or its overall business model.
So we're not just looking at one bad quarter or year.
Right.
We're looking for a pattern of decline
Thank
that
you.
suggests a more systemic issue.
Right. Another red flag is a high debt load, especially if the company is struggling to generate enough cash flow to service its debt obligations. This can put a strain on the company's finances
Right.
and limit its ability to invest in growth opportunities.
So debt in itself isn't necessarily a bad thing.
Right.
But it becomes a problem if it's excessive
Yeah.
or if the company's having trouble managing its debt burden.
Exactly.
What about the quality of the management team?
Yeah.
Is that something we should be scrutinizing as well?
Absolutely. The management team plays a crucial role in a company's success or failure.
Okay.
We want to see a team that's experienced, ethical, aligned with shareholder interests, and has a proven track record of success.
So we're looking for those leaders who have a vision for the future,
Right.
a commitment to creating value for their shareholders, and the ability to navigate through challenging times.
Exactly.
Are there any specific warning signs related to management that we should be aware of?
Certainly. One red flag is a history of poor capital allocation decisions.
Okay.
This could involve making ill-advised acquisitions, investing in projects that don't generate returns,
Right.
or squandering cash on lavish executive perks.
So we're looking for evidence that management is using the company's resources wisely and focusing on creating long-term value for its shareholders.
Right.
Another factor I've heard mentioned is the importance of a company's competitive advantage. Can you elaborate on that and how it relates to value investing?
Absolutely. A company's competitive advantage, also known as its moat, is what sets it apart from its rivals and allows it to generate profits over the long term.
Okay.
This could be anything from a strong brand to a unique product or service, a loyal customer base, a cost advantage, or a network effect.
So we're looking for companies that have something special.
Right.
Something that makes them stand out from the crowd and protects their profitability.
Exactly.
But how can we assess whether a company's competitive advantage is truly sustainable?
That's a great question. And it requires careful analysis of the industry dynamics and the company's position within that industry. We want to see a company that has a history of defending its market share, adapting to changing trends, and fending off new entrants.
So we're not just looking for a company that's doing well today. We're looking for a company that has the agility and resilience to thrive in the long term, even as its industry evolves and new competitors emerge.
Exactly. And that brings us back to the importance of fundamental analysis, really understanding the company's business model, its competitive landscape, and its long-term prospects.
Now, you mentioned earlier that value investing is a contrarian approach. Can you elaborate on what that means and why it's relevant for finding undervalued assets?
Value investing is contrarian because it often involves going against that prevailing market sentiment. It requires having the conviction to buy stocks that others are selling. Often because those stocks are out of favor or facing temporary challenges.
Right.
It's about zigging when the market sags.
So it's about seeing opportunity where others see risk. About having the courage to be different and to bet against the crowd.
Value investors see those moments of pessimism or neglect as potential buying opportunities. They're willing to swim against the tide because they believe that value will ultimately prevail.
But that requires a strong stomach and a willingness to stand apart from the crowd, right?
Absolutely. It's not easy to buy stocks that everyone else seems to be dumping.
Right.
It takes courage, conviction, and a deep understanding of your investment thesis. You have to believe that the market doesn't always reflect the true value of a company, and that sometimes the best opportunities are found in those neglected or misunderstood companies.
But how do we deal with the psychological challenges of being a contrarian investor? It can't be easy to go against the grain all the time, especially when the market seems to be proving you wrong.
That's true. Contrarian investing can be lonely at times.
Right.
You might feel like you're the only one who sees the value in particular stock. And when the market keeps going down, it can be tempting to doubt your analysis and give in to that herd mentality.
So it's not just about being right. It's also about having the mental fortitude to stick to your convictions, even when the market is testing you.
Contrarian investing requires a strong mindset, a belief in your own research, and a willingness to endure short-term pain for long-term gain.
Right.
And it's about not letting fear or doubt cloud your judgment.
One thing I've learned from our conversation today is that value investing isn't just about numbers and analysis. It's also about understanding human psychology, both our own and that of the market as a whole.
I couldn't agree more. Value investing is as much about understanding ourselves as it is about understanding the companies we invest in.
Now, I'd love to delve a little deeper into the process of fundamental analysis, how we actually go about evaluating a company's financial statements, assessing its management team, and determining its intrinsic value.
That's an excellent next step in our journey. Let's dive into the nitty-gritty of fundamental analysis.
Okay.
Hashtag TTS, the Deep Dive episode 2025-0209, part 3 of 3.
Okay, so let's continue our deep dive into this fascinating world of value investing.
Right.
We've talked about the mindset, the strategies, the importance of that emotional discipline.
Right.
Now I'm really eager to roll up our sleeves
Yeah.
and delve into the nitty-gritty of fundamental analysis.
Let's do it.
How do we actually go about dissecting a company's financial statements,
Okay.
assessing its management team, and ultimately determining its
Right.
intrinsic value?
That's the heart of value investing.
Yeah.
It's about going beyond those headlines
Yeah.
and really understanding what makes a company tick.
Okay.
It's like being a detective, piecing together those clues to uncover the true worth of a business.
So where do we begin our investigation?
Oh,
What are
yeah.
the essential financial statements
Oh,
that we
it's-
need to examine?
There are 3 key financial statements that every value investor should become familiar with.
Okay.
The income statement, the balance sheet, and the statement of cash flows.
Okay, let's start with the income statement.
All right.
Can you give us a quick rundown of what it tells us about a company?
The income statement, also known as the profit and loss statement, summarizes a company's revenues and expenses over a specific period, typically a quarter or a year. It shows us how much money the company brought in from its operations, how much it spent on those operations, and ultimately how much profit it made.
So it's like a snapshot of the company's financial performance over time.
Yeah.
We can see how its sales are trending, how well it's controlling its costs, and ultimately how profitable its business is.
Exactly. And there are several key metrics within the income statement that value investors pay close attention to.
Can you walk us through some of those key metrics?
Sure. One of the most important is revenue, which represents the total amount of money the company generated from its sales of goods or services.
Okay.
We want to see a company that's growing its revenue over time, indicating that its products or services are in demand and that it's gaining market share.
So revenue growth is a good sign, but it's not the whole story.
Right.
What are some other metrics we should be looking at?
Another crucial metric is gross profit, which is calculated by subtracting the cost of goods sold from revenue. It tells us how much money the company is making from its core operations before accounting for other expenses like marketing, administration, and research and development.
So gross profit gives us a clearer picture of the profitability of the company's core products or services.
Right.
What about net income, the bottom line of the income statement?
Net income, also known as profit or earnings, is the ultimate measure of a company's profitability.
Okay.
It represents the money that's left over after all expenses have been deducted from revenue.
Okay.
This is the number that often gets the most attention from investors.
Right.
As it reflects the company's overall financial performance.
Okay, so we've got revenue, gross profit, and net income.
Yeah.
Are there any other metrics within the income statement that value investors typically focus on?
One metric that can provide some valuable insights into a company's efficiency is its operating margin, which is calculated by dividing operating income by revenue.
Okay.
It tells us how much profit the company's generating from each dollar of sales.
So a higher operating margin suggests that the company's more efficient
Exactly.
at managing its costs and generating profits.
And another metric that can be helpful in assessing a company's profitability is its net profit margin, which is calculated by dividing net income by revenue. It tells us how much profit the company's keeping for every dollar of sales after all expenses have been paid.
Okay, so we've got a pretty good understanding of the income statement now.
All right.
Let's move on to the balance sheet.
Okay.
What kind of insights can we glean from that?
The balance sheet provides a snapshot of a company's assets, liabilities, and shareholder equity at a specific point in time. It essentially tells us what the company owns, what it owes, and what's left over for its owners.
Okay, can you break down each of those components for us? What are assets, liabilities, and shareholder equity?
Assets are the things that a company owns that have value, such as cash, accounts receivable, inventory, property, plant, and equipment.
So assets represent the resources that a company uses
Right.
to generate revenue and profits. What about liabilities?
Liabilities are the company's obligations to others, such as accounts payable, salaries payable, loans, and bonds.
So liabilities represent the money that a company owes to its creditors.
Exactly.
And finally, what is shareholder equity?
Shareholder equity represents the ownership interest
Oh,
in the company.
yeah.
It's the value of the assets that are left over after all liabilities have been paid.
So if we were to simplify the balance sheet into a single equation,
Yeah,
it would be assets minus liabilities equals shareholder equity. Is that correct?
precisely. And there are several key ratios
Okay.
that value investors use to analyze the balance sheet and
Mhm.
assess a company's financial health.
Can you walk us through some of those key ratios?
Sure. One of the most widely used is the current ratio,
Okay.
which measures a company's ability to pay its short-term obligations
Mm-hmm.
with its short-term assets.
Mm-hmm.
It's calculated by dividing current assets by current liabilities.
So a higher current ratio suggests that the company has more cushion to cover its short-term debts.
And another important ratio is the debt-to-equity ratio,
Okay.
which measures a company's financial leverage. It's calculated by dividing total debt
Mm-hmm.
by shareholder equity.
So a higher debt-to-equity ratio indicates that the company is using more debt to finance its assets,
Right.
which could increase its financial risk.
Precisely.
Mm.
And a final ratio that can be helpful in assessing a company's liquidity
Okay.
is the quick ratio, also known as the acid test ratio.
Okay.
It's a more stringent measure of short-term liquidity than the current ratio,
Mm-hmm.
as it excludes inventory from current assets.
Oh, yeah, that makes sense. Now, let's move on to the statement of cash flows.
Right.
What kind of information does that reveal about a company?
The statement of cash flows tracks the movement of cash,
Okay.
both into and out of a company over a specific period.
Mm-hmm.
It shows us how much cash the company generated from its operations,
Okay.
how much it invested in its business, and how much it raised or spent on financing activities.
So the statement of cash flows gives us a more detailed picture
Yeah.
of where the company's cash is coming from
Right.
and where it's going. Why is this information so important for value investors?
Because cash is king.
Right.
A company can be profitable on paper,
Mm-hmm.
but still struggle if it's not generating enough cash to cover its expenses
Yeah.
and invest in its growth. The statement of cash flows helps us assess
Okay.
a company's ability to generate cash and use it effectively.
Now, we've covered the three main financial statements,
Right.
but there's another crucial element of fundamental analysis that we need to address.
Okay.
The quality of the management team. How can we evaluate whether a company has a strong and ethical leadership team
Yeah,
that's aligned with the interests of its shareholders?
that's a great question, and it's often one of the most challenging aspects of fundamental analysis.
Okay.
We need to look beyond the numbers and assess the character,
Mhm.
the competence, and the integrity of people running the business.
So it's about evaluating their track record,
Right.
their decision-making process,
Mm.
and their overall commitment to creating long-term value for the company.
Exactly.
Are there any specific red flags that might suggest a management team's not worthy of our trust?
Certainly. One major red flag is a history of unethical behavior,
Okay.
such as accounting irregularities, misleading statements to investors,
Mm-hmm.
or self-dealing transactions. These are all signs that management may be prioritizing
Right.
their own interests over those of the shareholders.
So we're looking for a management team that's transparent,
Yeah,
accountable, and operates with integrity.
absolutely.
What are some other warning signs we should be aware of?
Another red flag is excessive executive compensation,
Okay.
especially if it's not aligned with the company's performance.
Right.
We want to see a management team that's rewarded for creating value for the shareholders,
Mm-hmm.
not for enriching themselves.
So we're looking for a pay structure that's fair,
Right.
reasonable, and incentivizes management to act in the best interests of the company and its owners.
Yeah.
Are there any other aspects of management quality that we should consider?
It's also important to assess management's capital allocation skills.
Okay.
Are they investing the company's resources wisely
Mm-hmm.
in projects that generate returns, or are they squandering cash
Right.
on ill-advised acquisitions or vanity projects?
So we're looking for a management team that has a clear strategy
Yeah.
for allocating capital, a disciplined approach to spending, and a track record of making sound investment decisions.
Exactly. And finally, we want to see a management team
Okay.
that communicates effectively with shareholders,
Right.
providing clear and transparent information about the company's performance, its challenges, and its long-term prospects.
So open and honest communication accountability to shareholders, and a shared commitment to creating long-term value are all hallmarks of a high-quality management team.
They are.
Now, we've covered a lot of ground on fundamental analysis, but I think it's important to acknowledge that it's not an exact science. There's always an element of subjectivity involved, right?
Absolutely. There's no one-size-fits-all formula for determining a company's intrinsic value. Different investors may use different valuation models, interpret financial data differently, and arrive at different conclusions. The key is to be consistent with your approach, to be thorough in your research, and to be conservative in your estimates.
So it's about developing your own investment philosophy, your own set of criteria for evaluating companies, and your own risk tolerance. And it's about being humble enough to recognize that you won't always be right. And that sometimes the market will disagree with your assessment.
Exactly. Value investing is a journey, not a destination. It's a constant process of learning, adapting, and refining your skills.
Now, one final thought I'd love to leave our listeners with is this idea of applying these principles of value investing beyond the realm of stocks and financial markets. Could we use a similar framework for making decisions in other areas of our lives?
It's interesting.
Perhaps when buying a car, choosing a home, or even evaluating career opportunities.
That's a brilliant insight. The principles of value investing, such as focusing on intrinsic worth, seeking out a margin of safety, and thinking long-term, can absolutely be applied to many aspects of life. It's about making those informed decisions, weighing the costs and benefits, and choosing those options that offer the greatest value over the long haul.
So in a sense, value investing isn't just a financial strategy.
It's not.
It's a philosophy for living a more deliberate and fulfilling life.
I couldn't agree more. It's about making choices that align with our values, our goals, and our aspirations.
And that's a powerful message to end on. Thank you for joining us on this deep dive into value investing and dollar cost averaging. We hope you've gained some valuable insights and are inspired to embark on your own journey of financial discovery.
Thanks for having me.
All right, so you want to get inside the mind of Benjamin Graham, the father of value investing, and how his principles can help you navigate today's market right. We've got a stack of articles and excerpts you sent over. We'll be exploring his core ideas, modern applications of his strategies, and even some real-life examples that might surprise you. By the end of this deep dive, you'll have a solid grasp of Graham's wisdom and how it can potentially lead to profitable decisions.
What's fascinating about Graham is that his influence extends far beyond Wall Street.
Oh, really?
His principles have implications for decision-making in various aspects of life, from evaluating businesses to assessing risk in everyday situations.
To kick things off, can you give us a quick overview of who Benjamin Graham was and why his ideas still matter today?
Sure. Benjamin Graham is widely considered the father of value investing. And for good reason. He wasn't just an investor. He was a deep thinker who developed a systematic approach to analyzing businesses and identifying investment opportunities. He was also a mentor to Warren Buffett, which speaks volumes about his impact. His books, Security Analysis and The Intelligent Investor, are considered essential reading for anyone serious about investing.
Okay, so we're talking about a heavyweight in the world of finance. Now, I'm intrigued by this idea of different types of investors. I read that Graham had some specific categories.
He did. Graham recognized that not all investors have the same goals, time commitment, or expertise. He categorized investors as either enterprising or defensive. Enterprising investors are those who are willing to put in the time and effort to research individual companies deeply. They're looking for undervalued opportunities that the market might be missing.
And that's where the work equals return principle comes in, right? The more effort you put into research, the better your potential return.
Precisely. But here's a key insight. It's not just about working hard. It's about working smart. You can maximize your work by focusing on areas the market often overlooks, like understanding a company's management incentives or digging into the footnotes of financial statements. Those are the places where you might uncover hidden gems or red flags that others miss.
So it's like being a detective looking for clues that reveal a company's true value.
Exactly. And for those who don't have the time or expertise to be financial detectives, Graham recommended a more passive approach, which is where the defensive investor comes in.
For our listener who might not be spending their evenings poring over financial statements,
Yeah.
what did Graham suggest?
For defensive investors, Graham suggested investing in a broadly diversified portfolio,
Okay.
such as an index fund that tracks the S&P 500.
Hmm.
This approach aims to capture the overall market return without the need for extensive individual stock analysis.
That makes sense. Kind of a set it and forget it approach for those who want to participate in the market without getting too deep into the weeds.
Yes, but here's where it gets interesting. Even with this seemingly simple strategy, many investors fail to achieve even average returns.
Hmm.
This is where understanding the psychology of the market becomes crucial, and this is where Graham's famous analogy of Mr. Market comes into play.
Ah, yes, Mr. Market. Everyone talks about this,
Right.
but what exactly does it mean?
Imagine a character, Mr. Market, who shows up at your door every day offering to buy or sell stocks.
Okay.
The catch is that Mr. Market is driven purely by emotion, fear, greed, excitement, pessimism.
Hmm.
He's not rational, he's swayed by the mood of the moment.
So Mr. Market is like that friend who's always either euphoric or panicking, and their emotions are contagious.
Exactly. And just like with that friend, you don't want to let their mood swings dictate your decisions.
Right.
A savvy investor recognizes that Mr. Market's offers aren't always rational.
Hmm.
Sometimes he's overly optimistic, driving prices up,
Okay.
and other times he's overly pessimistic, offering bargains.
So how do we avoid getting swept up in Mr. Market's emotional roller coaster?
That's where another key principle comes in. Focusing on a company's intrinsic value,
Okay.
what it's truly worth based on its fundamentals,
Hmm.
rather than its fluctuating stock price.
And that brings us to another one of Graham's most important concepts, the margin of safety, right?
Absolutely. This is about minimizing risk by buying a stock below its intrinsic value.
Okay.
Think of it like building a bridge. Engineers design bridges to withstand more weight than they'll ever actually carry.
Hmm.
That extra strength is their margin of safety.
So it's about having a buffer just in case things don't go exactly as planned.
Exactly. It's a way of protecting yourself from the unexpected, whether it's an economic downturn, a change in industry dynamics, or simply an error in your own analysis.
I love how this concept of margin of safety connects to real-life examples. Remember Sullenberger's decision to land that plane on the Hudson River?
Oh, yeah.
He chose the option that offered the greatest margin of safety for the passengers, even though it wasn't the conventional approach.
Brilliant example. It highlights how this principle applies beyond investing. It's about making decisions that minimize downside risk, even in the face of uncertainty.
Now, we've talked about Graham's focus on intrinsic value and margin of safety.
Right.
But how did he apply these principles in practice? Let's move on to some examples of how he successfully navigated the markets.
One of Graham's most famous investments was in the Northern Pipeline Company in the late 1940s.
Okay.
This wasn't a glamorous tech company
Right.
or a household name.
Yeah.
It was a pipeline operator that had fallen out of favor with investors.
Sounds like a classic cigar butt situation.
Right.
What did Graham see in this company that others missed?
He recognized that the market was undervaluing Northern Pipeline's assets. The company owned a vast network of pipelines
Okay.
that transported natural gas, a vital commodity.
Hmm.
Graham meticulously analyzed the company's financials
Hmm.
and determined that the market price was significantly below the liquidation value of its assets.
So even if the company went belly up, its assets were still worth more than what the market was reflecting?
Yes, exactly. Graham saw this as a classic margin of safety situation. Even if his growth assumptions were wrong, the downside risk was limited because the assets provided a floor on the investment.
Okay.
He bought a significant stake in Northern Pipeline, and over time, the market recognized its true value. Graham's investment generated substantial returns, proving that even unglamorous businesses can offer compelling opportunities if you know where to look.
That's a great example of how Graham's principles can be applied to find those hidden gems that others might overlook. But it seems like today's market moves so fast. Are there any more recent examples of how his ideas are still relevant in the modern investing landscape?
Absolutely.
Yeah.
Let's fast forward a few decades and look at Warren Buffett's investment in American Express back in the
Express?
1960s. This is a classic case of recognizing intrinsic value even when the market is panicking.
Right.
Remember the salad oil swindle?
Wait, what was that? Refresh my memory.
In the early 1960s, a company called Allied Crude Vegetable Oil was caught inflating its inventory of salad oil. They were basically using barrels of water with just a bit of salad oil floating on top
Oh, wow.
to deceive auditors and create the illusion of a massive stockpile.
That's sneaky.
It was a huge scandal, and it had ripple effects throughout the market. American Express, a financial services company at the time,
Okay.
had issued loans backed by these fake oil inventories.
Oh, no.
When the scandal broke, American Express's stock price plummeted.
So this is where Mr. Market went haywire, driven by fear and uncertainty.
Exactly. Investors were panicking, selling off American Express shares, worried about the company's potential losses. But Buffett saw through the noise. He recognized that American Express had a strong core business, a loyal customer base, and a powerful brand.
Hmm.
He understood that the scandal, while serious, didn't fundamentally damage the company's intrinsic value.
Okay.
It was a temporary setback, and the market was overreacting.
So Buffett, like Graham, was looking beyond the immediate crisis and focusing on the long-term potential.
Precisely. He saw an opportunity to buy a great company at a deeply discounted price. He swooped in and bought a substantial stake in American Express, betting that the market would eventually recognize its true value.
And that bet paid off handsomely, right?
It did. Over the next decade, American Express's stock price soared.
Wow.
And Buffett's investment generated incredible returns. It's a testament to the power of staying calm amidst market turmoil and sticking to the principles of value investing.
This is a great illustration of how understanding a company's intrinsic value can lead to profitable decisions, even when the market is sending conflicting signals.
Yeah.
I'm starting to get a feel for how these principles can be applied.
Right.
But what about something more recent, something that happened in my lifetime? Could you give me an example of how Graham's ideas played out during the dot-com bubble?
The dot-com bubble of the late 1990s and early 2000s is a fascinating case study in market psychology and the dangers of ignoring Graham's principles. Remember all those internet companies with sky-high valuations, even though many of them had no profits or even a clear business model?
Oh, yeah. It felt like everyone was throwing money at anything with a .com in its name. It seemed like a new era where the old rules didn't apply.
Exactly. It was a classic case of market euphoria driving prices far beyond any reasonable measure of intrinsic value. Many investors abandoned traditional valuation metrics, believing that the internet had fundamentally changed the rules of business. They paid exorbitant prices for companies that couldn't deliver on their promises.
What were some of the warning signs that value investors might have recognized during that time? What could they have learned from Graham?
A value investor looking through Graham's lens would have seen numerous red flags. Companies were being valued based on speculative metrics like eyeballs or website traffic, rather than actual earnings or cash flow.
Oh, wow.
Many companies were burning through cash at an alarming rate with no clear path to profitability.
So they were essentially building castles in the sky, hoping that profits would magically appear someday.
Yes, and as Graham emphasized, hope is not a sound investment strategy. He always stressed the importance of focusing on tangible factors like assets, earnings, and dividends. During the dot-com bubble, many investors ignored these fundamentals, driven by FOMO hype and the belief that this time it's different.
And of course, the bubble eventually burst, right?
It did, and those who had ignored Graham's warnings about margin of safety and focusing on intrinsic value paid a heavy price. Many of those high-flying internet companies crashed and burned, wiping out billions of dollars in investor wealth.
So even in a period of unprecedented technological advancement and economic growth, the basic principles of value investing remained relevant.
Absolutely. The dot-com bubble is a stark reminder that market psychology can drive prices to irrational extremes and that those who disregard fundamental valuation principles do so at their own peril.
Right.
But here's the fascinating part.
Okay.
Even during the dot-com frenzy, there were investors who stuck to Graham's teachings and managed to not only avoid the carnage, but also profit from it.
Now that's what I call impressive. How did they manage to do that?
One such investor is Seth Klarman, who we mentioned earlier. He's a true disciple of Graham and has built an incredibly successful track record by adhering to the principles of value investing.
Give us the rundown on Klarman. What sets him apart?
Klarman is known for his deep value approach, focusing on undervalued assets with large margins of safety. He's also a contrarian investor, meaning he's willing to go against the crowd and buy what others are selling. During the dot-com bubble, while many investors were chasing high-flying tech stocks, Klarman was busy looking for bargains in overlooked or out-of-favor sectors.
So he was essentially betting against the bubble. That takes some serious courage. What was one of his most notable moves during that time?
One of Klarman's most famous investments during the dot-com era was in a company called Palm Inc., which made handheld computers.
I vaguely remember those. Weren't they like the precursors to smartphones?
Yes, exactly. Palm was a pioneer of the mobile computing space, and at the peak of the dot-com bubble, their stock price was soaring. But Klarman saw something that most investors missed. Palm had recently spun off a subsidiary called PalmSource, which
Okay.
developed the operating system for Palm's devices. Klarma believed that PalmSource was significantly undervalued, while Palm, the parent company, was overvalued.
Okay, I'm starting to see where this is going.
Yeah,
So Klarman took a contrarian approach, betting against the parent company and on the undervalued spinoff.
exactly. He shorted Palm stock, essentially betting that its price would decline, and simultaneously bought shares of PalmSource betting that its price would rise. As the dot-com bubble began to deflate, Klarman's thesis played out perfectly. Palm stock price plummeted, while PalmSource's stock price held steady. Klarman's contrarian bet generated significant profits, proving that even in a wildly speculative market value, investing principles can prevail.
This is a fascinating example of how understanding spin-offs and corporate restructuring can uncover hidden opportunities.
Right.
It's like finding a diamond in the rough, recognizing value where others see complexity or uncertainty.
It is. And it highlights the importance of thinking independently and not getting swept up in the herd mentality. Value investing often requires going against the grain, being willing to see what others miss, and having the conviction to act on your convictions.
I'm really starting to appreciate the depth and complexity of Graham's ideas. It's not just about finding cheap stocks.
Right.
It's about a mindset, a way of thinking about value risk and market psychology that can lead to better decision-making in all aspects of life.
I couldn't agree more. It's a framework for rational decision-making that transcends the realm of finance.
Now, we've talked a lot about Warren Buffett and Seth Klarman, both of whom have achieved remarkable success using Graham's principles.
Right.
But I'm curious, did Buffett always follow Graham's teachings to the letter? Didn't he evolve his approach over time?
That's a great observation.
Yeah.
While Buffett has always acknowledged Graham's profound influence, he hasn't been afraid to adapt and refine his approach based on his own experiences and the changing dynamics of the market.
So he took Graham's foundational ideas and built upon them. What were some of the key shifts in Buffett's investment philosophy?
One of the most notable shifts has been Buffett's move away from pure cigar butt investing
Okay.
towards a focus on high-quality companies with durable competitive advantages, or moats, as he calls them.
That's right. I remember reading about how early in his career, Buffett was content to buy those deeply undervalued, potentially troubled companies that Graham was known for. But over time, his focus seemed to shift. What prompted that change?
Several factors were at play.
Hmm.
One was simply the size of his investment portfolio.
Okay.
As Berkshire Hathaway grew, it became increasingly difficult to find enough cigar butt opportunities to move the needle. He needed to invest in larger, more established companies to deploy his capital effectively.
That makes sense. As your capital base grows, you need bigger targets to generate meaningful returns. But I imagine there was more to it than just portfolio size, right? What else influenced Buffett's thinking?
You're right. Buffett also realized that even though cigar butt investing could yield quick returns, it wasn't always a sustainable strategy. Those cheap, declining companies often faced significant headwinds that were difficult to overcome.
Right.
He began to appreciate the power of compounding returns over the long term, which led him to favor companies with enduring qualities.
So he started prioritizing quality and durability, even if it meant paying a slightly higher price.
Exactly.
He realized that investing in high-quality companies with sustainable competitive advantages, those moats we talked about, could lead to more predictable and long-lasting returns.
This is a great transition point to something I've been wondering about. You mentioned that Graham categorized investors as either enterprising or defensive. Where does Buffett fit into these categories? Would you consider him an enterprising investor or a defensive investor?
That's a fascinating question. I think Buffett embodies aspects of both.
Oh, really?
He's clearly an enterprising investor in the sense that he's willing to put in the time and effort to research companies deeply and make concentrated bets.
But he also exhibits qualities of a defensive investor in his focus on long-term, holding his emphasis on margin of safety and his aversion to excessive risk.
So he's kind of a hybrid, blending the best of both worlds.
Exactly. And I think that's one of the key takeaways from Buffett's career.
Okay.
He's shown that value investing is not a rigid dogma. It's a flexible framework that can be adapted to different investment styles and market conditions.
That's a really encouraging thought for those of us who are just starting out on our investing journey. It means we can find our own path within this framework, drawing inspiration from Graham and Buffett while tailoring our approach to our own individual goals and circumstances.
Absolutely. It's about finding what works best for you, always keeping in mind the core principles of value investing.
This has been incredibly insightful. We've covered a lot of ground, from Graham's early investments to Buffett's evolution as an investor, and we've even touched on how these principles played out during the dot-com bubble. But there's one question that's been lingering in my mind. If Buffett himself shifted away from buying those classic cigar butt stocks,
Right.
the deeply undervalued, potentially troubled companies that Graham was known for,
Yeah.
does that mean those opportunities no longer exist? Or are they just harder to find in today's market?
That's the million-dollar question that every value investor grapples with. While the market has become more efficient and information more readily available, I believe those classic cigar butt opportunities are still out there. They might be rarer and require more digging, but they haven't vanished entirely.
So it's like panning for gold. You might have to sift through more dirt and gravel, but those nuggets are still there waiting to be discovered.
Exactly. The key is knowing where to look. Instead of focusing on the hottest sectors or the most talked about companies, value investors seeking cigar butts often venture into overlooked or out-of-favor areas of the market.
Okay, so we're talking about going against the crowd, looking where others aren't. Can you give me an example of a specific industry or sector that might be ripe for cigar butt investing today?
Let's consider the retail sector. The rise of e-commerce has disrupted traditional brick-and-mortar retailers, leading to store closures, declining sales, and plummeting stock prices for many companies in this space.
Yeah, it seems like every week there's news of another retailer struggling to stay afloat. But from a value investing perspective, wouldn't this be a red flag? Isn't retail a dying industry?
That's the perception, and that's precisely why it might be an interesting area for cigar butt investors to explore. While it's true that the retail landscape is undergoing a massive transformation, not all retailers are created equal. There might be hidden gems within this sector, companies with strong brands, loyal customer bases, valuable real estate assets, and perhaps most importantly, the ability to adapt to the changing dynamics of the industry.
So it's about finding those retailers that are managing the transition well.
Yeah, the ones that are innovating and evolving their business models to compete in the digital age.
Exactly. It's about looking beyond the headlines and digging into the fundamentals to assess whether the market's pessimism is justified. Are there signs of a turnaround? Is the management team taking the right steps to adapt? Is the stock price significantly below the company's intrinsic value, even after factoring in the challenges it faces?
This makes me think about department stores. They've been hit particularly hard by the rise of e-commerce and changing consumer preferences. Would this be a potential area to find cigar butts?
It could be. Many department stores are trading at incredibly low valuations. But as a value investor, you wouldn't just blindly buy any department store stock. You'd need to carefully analyze each company, looking for signs of strength and resilience. Does the company own valuable real estate? Are they streamlining their operations and closing underperforming stores? Are they investing in their online presence and omnichannel strategies? Are they catering to a niche market or offering unique products or services that differentiate them from the competition? So even within a struggling sector like retail, there might be companies that are positioning themselves for a comeback or at least a more gradual decline. And if the market is overly pessimistic, those companies might be trading at a significant discount to their true worth.
Precisely. That's the essence of cigar butt investing, finding those overlooked opportunities that others might dismiss as lost causes. But it's important to remember that this type of investing carries higher risks.
Right. It's not for the faint of heart. What are some red flags that investors should watch out for when evaluating potential cigar butts? What are the signs that a company might be a value trap rather than a hidden gem?
One major red flag is excessive debt. If a company is struggling and heavily indebted, it might be a sign of deeper problems. The weight of that debt can make it difficult for the company to invest in growth, adapt to changing conditions, or even just stay afloat.
So it's not just about finding a low stock price. You need to make sure the company has the financial strength to weather the storm and potentially turn things around. What else should investors pay attention to?
Another critical factor is management quality. You want to see a management team that is experienced, aligned with shareholder interests, and has a clear plan for addressing the company's challenges. A competent and trustworthy management team can make all the difference in a turnaround situation.
So it's like investing in a captain to steer the ship through rough waters.
Yeah.
You need someone with a steady hand and a clear vision. What about industry trends? How do those play into evaluating potential cigar butts?
Industry trends are crucial. You need to assess whether the industry itself is in a secular decline or just experiencing a temporary setback. For example, the decline of print media is likely a secular trend, while the challenges faced by department stores might be more cyclical or driven by temporary factors like the pandemic.
So a value investor would be more likely to find cigar butts in industries experiencing temporary headwinds rather than those facing long-term structural decline.
Yes, that's generally the case. But even within declining industries, there might be niches or subsectors that are more resilient or have the potential for growth. It's all about identifying those pockets of opportunity and conducting thorough research to assess the long-term viability of the business.
This has been incredibly insightful. I feel like I have a much better understanding of how to approach cigar butt investing, what to look for, and what red flags to avoid. But let's be honest, this type of investing requires a lot of work, a lot of patience, and a certain level of risk tolerance.
You're absolutely right. Cigar butt investing is not for everyone. It's a specialized niche within the broader world of value investing, and it's certainly not a passive strategy. But for those who are willing to put in the effort, who have the patience to see their thesis play out, and who are comfortable with a higher level of risk, it can be an incredibly rewarding approach.
I think that's a great point to emphasize. Value investing in all its forms is about finding your own path, understanding your strengths and weaknesses as an investor, and aligning your strategy with your individual goals and temperament.
Couldn't agree more. It's about continuous learning, adapting to changing market conditions, and staying true to the core principles that have guided successful investors for generations.
We've covered so much ground in this deep dive. We explored Benjamin Graham's foundational ideas, saw how they've been applied by legendary investors like Warren Buffett and Seth Klarman, and even delved into the nuances of cigar butt investing. What are some key takeaways that you hope our listener will walk away with?
First and foremost, I hope they gain a deeper appreciation for the enduring relevance of Graham's principles. Even in today's fast-paced, technology-driven market, the core concepts of value investing, understanding intrinsic value, buying with a margin of safety, and ignoring the noise of the market are as important as ever.
I think that's a powerful message. It's reassuring to know that these principles have stood the test of time and continue to guide successful investors across generations.
Absolutely. I also hope our listener has gained a better understanding of the different approaches to value investing, from Buffett's focus on high-quality companies to Klarman's contrarian bets to the classic cigar butt style that Graham was known for.
And most importantly, I hope our listener feels empowered to apply these principles to their own investment journey.
Yes, whether they choose to focus on individual stock picking, index fund investing, or something in between, understanding the principles of value investing can help them make more informed decisions and navigate the complexities of the market with greater confidence.
This has been an incredible deep dive, and I want to thank you for sharing your expertise and insights with us.
It's been a pleasure. I always enjoy exploring the world of value investing and sharing these ideas with others.
And to our listener, thank you for joining us on this journey. We hope you found it valuable and insightful. Remember, the world of investing is a constant learning process. Stay curious, stay informed, and most importantly, stay true to your investment principles.
Happy investing.
And until next time, keep diving deep.